Commission. You should all see an agenda in front of you, and if we might have a motion to adopt the proposed agenda.
So moved.
And
Second.
a second. All in favor?
Aye.
Very well. It's unanimously passed. Second, I think posted to Watch Docs, you may have seen a copy of the minutes from our June 22nd meeting. If so, if there might be a motion to adopt those minutes.
So moved.
And a
Second.
second. And a second. All in favor? Aye. I think the ayes have that as well. Next order of business is the chair's report. I think the first thing, we have a set of proposed meeting dates for 2018. Are those in everyone's packets, or were those on?
They're on the screen.
Oh, they're on the screen right there. So we will be circulating the dates around to everybody for the purpose of identifying any conflicts. And then I think in December, we will go ahead and adopt these for the 2018 calendar. So if you don't mind checking your own calendars and making sure that indeed these work for you. The other thing I would like to do is, you may see we have a couple of new faces at the table, and I would like to introduce, this is Makita Investment Group. And I think you may have remembered back earlier this year, we had an RFP process to identify a new general investment consultant, and Makita, we are very fortunate to have them as a result of that process. They were actually founded 38 years ago, and they serve over 160 clients representing $900 billion in aggregate assets. Makita now embraces the fiduciary responsibility in their role as investment consultant and will assist the Commission in focusing on guiding and governing RSIC. Our two actually members that are with us, we have Mr. Frank Benham, and if I get anything wrong in your very impressive resume, please let me know. But he holds an undergraduate degree in finance from Bentley College. He holds both CFA and Kaya designations. And as the managing principal and the director of research for Makita, Mr. Benham leads the design of the firm's portfolio construction and oversees all of the firm's research projects, including the annual asset study. Mr. Benham has more than 18 years of investment consulting experience, and he is actually based out of their firm headquarters, which are in Boston. And next to him, we have Mr. Aaron Lally, who received his undergraduate degree in economics from Boston College. He also holds CFA and Kaya designations. Mr. Lally is the vice president of Makita and has more than 8 years of investment experience. And prior to joining Makita, he worked as a fund accountant and securities pricing analyst for JP Morgan Chase. He now works with nonprofits, public funds, multi-employer clients, and he provides investment research to the firm. He is actually based out of Makita's Florida office. So I welcome you, a very warm welcome to you guys. Thank you very much for being here, and we are looking forward. They actually have a couple of items on the agenda as we progress, and we are really looking forward to hearing from you later on. Thank you, and welcome. And I do believe that concludes my report. I think the next report is from the Audit and Enterprise Risk Management Committee.
Yeah, so the audit committee met, on August 28th, Andrew provided an update on compliance, and there were no material exceptions noted during the quarter. All the annual investment manager compliance questionnaire responses have been received back. So I think our vendors are getting more kind of in the pace, and so I think that process, I don't think Andrew's here, but oh, there you are. I think it's running, it's getting smoother and smoother. I mean, people are getting more familiar with it, which is good. And staff had completed initial review of those responses. We also discussed our planning for the fiduciary audit. That is now an annual process, but the fiduciary auditor is to be selected by the state auditor. And the state auditor has already begun that planning process and had a review and discussion with RSIC staff on the topic. And the fiduciary audit report by law is due no later than the January 15th of 2019. The audit committee received an update on the implementation recommendations from a review done by Aspiris and RSIC on internal and fixed income trading. That was presented actually at the February audit committee, and the review yielded 18 recommendations, and Andrew reported that 14 of the 18 had already been implemented. The committee also approved the expansion of the scope of the prior agreed-upon procedures review to be completed by Clifton Larson Allen focusing on valuation and due diligence guidelines, and that comes up in a couple of months. The committee also discussed with Andrew at a high level kind of what a GIPS compliant review entails. That's kind of a newer area. People are starting to have pension plans develop sort of a body of reporting standards. We're only aware of a couple of plans that have taken that full step, but it is something that's getting discussed. So we discussed the possibility of having an RSIC look to undergo a GIPS compliance review. So we're right now kind of in that data collection stage, looking to collect samples of other plans that have had that type of work done. And so we're getting additional information from staff. And then personnel update. It's kind of been open, but the committee has extended an offer which has been accepted for the new Director of Audit and Enterprise Risk Management. But we will introduce him at the next commission meeting because, Mike, maybe you can give a quick, I guess we're still contracting, or he's still working out some final contractual things?
He's, I believe the projected, the agreed upon start date, I believe, is October the 9th. So I think he's just, still cleaning up a few affairs with his former employer. So we'll be happy to introduce him at the December meeting.
Yeah, and so that's something we're very happy about. We've been looking for a long time, and we've done a lot of interviews and a lot of resumes, and so we're excited to have that hire coming on board. Right.
We are excited too.
Yeah. Nobody more than Andrew.
Yeah.
So that is the update from the audit committee.
Wonderful. Thank you. Thank you. I think next we have an update from the Human Resources and Compensation Committee. Dr. Wilder.
Thank you. The committee met on September 15th, and at the meeting, in the open session part, one of the key items was the announcement of the promotion of Brittany Story to be Human Resources Manager. Brittany, will you stand so everyone can see you? So Brittany is our new Human Resources Manager. She will report to Andrew up the chain of command. We also discussed the committee charter, and staff told us that we were pretty much on track in fulfilling the obligations of the charter. We then went into executive session, heard a report on changes to staff, such as promotions, arrivals, departures, and salary changes. Also in the executive session, we discussed the evaluation of the CEO and also a change in compensation for the CEO. I'll report on the evaluation and compensation discussion once we go into executive session. Are there any questions?
Okay, well, thank you very much, Dr. Wilder. I think next on the agenda is the report of the CEO. Mr. Hitchcock.
Thank you, Madam Chair. First of all, I would like to take an opportunity to introduce a couple of new faces that we have. And so, Kara, if you'll stand up so everybody can see you. This is Kara Barak. Kara is our new Director of External Policy. She will be handling all of our governmental relations affairs. So anything dealing with the General Assembly or any other agencies of state government, Kara will be our point person for that. We are very fortunate to have her decide to join our team. She's a veteran staffer for the House Ways and Means Committee, most recently before coming to us. She was a budget analyst for the Higher Education Subcommittee in her previous role there. However, she also has extensive experience working with the retirement system. She was one of the lead staffers in the House on the 2012 pension reform legislation, so she has a good fundamental knowledge of who we are, and so I think we're going to be able to. That's going to pay dividends. She has a fantastic reputation working with the House. She has extensive contacts throughout the State House and throughout all of state government. I can't tell you how many people that I know from over there that have approached me after it became known that she was coming over here and telling me how lucky we were to have her. And she just really brings to the table a deep and granular understanding of not only the legislative process, but also the budgeting process that I think we're going to be able to capitalize on. So we're very excited and fortunate to have her join our team. We also have Shane Dixon. Shane, if you'll stand. Shane joins us. He's going to be Shane is one of 2 new members to our IT team, and I think as many of you know, we're taking on through our cooperation with PIBA, we're taking on some additional responsibilities regarding our IT to try to bifurcate a little more our infrastructure and PIBA's infrastructure for. So we're taking on a little bit more responsibility in that regard, but still happy to have PIBA as our main IT provider. But as a result of that, we brought on 2 new team members. Shane joins us most recently from Spirit Communications. He also spent time at the Department of Commerce responding to help desk requests. He'll be filling the role of IT service technician, where he'll be responding to everyday help desk requests. We also have Eric Baker. Eric, if you'll stand. Eric joins us most recently from the South Carolina Department of Probation, Parole, and Pardon Services, where he worked as a data center administrator, and he will be fulfilling the role of systems administrator, where he'll be assisting us with the Office 365 implementation and domain changes within PIBA. So very fortunate to have those folks. So, yeah. The next item that I have for you is our annual budget request, which we need to submit to the Executive Budget Office. And this has been obviously posted for your review. And I'm probably going to try to run through this rather quickly because we're really not asking for any changes. But if you have any questions or concerns, please stop me along the way. First of all, the organizational chart. And then moving on to our appropriations history, just a reminder for everyone that we are solely other funds. So we operate solely on trust funds. We don't operate on, we don't get any money from the general fund. So, and our appropriation is actually an authorization to expend trust funds. It's not necessarily an appropriation of general funds. So when money is authorized for our use, we're not taking from any other state agency. I think one of the notable things to see is in both of the past 2 budget years, we've asked for reductions in our authorization. For fiscal year 17, that was a $500,000 reduction in our authorization. And in fiscal year 18, so the budget year that we're in, that was a $1.5 million reduction in our authorization. Usually that is met with shock and surprise by the folks across the street, and we're asking for less authorization. But this year, I think it's a good time for us to pause and to just try to maintain the status quo, both as far as budget authorization goes and as far as our FTEs go. So I'm asking really for no changes in regards to our budget authorization and our FTEs.
Do you have any open FTEs still?
We do, and we have some of those are designated already. I think we've got, I'll show you. There's a slide in just a minute, but and even after that, we're still going to have a few open, and I want to hang on to those just as we kind of move forward, to look at, we're going to bring anything more in-house, and as we kind of continue to look at the portfolio. So, our budget is really just 3 main pieces. We have personal services, which is the biggest piece. Our employer contributions, which is the contributions that are made to benefits, and then our other operating expenses. That's our current funding. Our budget request is exactly the same. And then we're not, as I said, we're not requesting any additional authorization. We're not requesting any additional FTEs. Just to give you an idea of our FTE request through time, we're just holding steady at the 51. We currently have 7 FTEs open. One of those would be utilized by hiring a director for the private markets. We feel like we have a need for a senior officer in our private debt and potentially an additional analyst in private equity. We'll have also looking to utilize one of those as hiring a risk analyst, and then 3 FTEs will be utilized by hiring. We have 6 FTEs dedicated to our junior analyst program. 3 of those are currently open, and those just kind of, we roll through those as people cycle through the program. So, yeah, we're still phasing in the program, and, and there's arrivals and departures in that program, which is to be expected. I don't necessarily think that the other FTEs other than the junior analyst program and the risk analysts are necessarily set in stone, but this is the allocation for those right now. But as we, kind of move forward and see what needs we have, and as we, kind of fully explore and understand the capabilities or what Alborn brings to the table in regards to serving as an extension of staff, I think some of that may change as well.
May I
Yes,
ask,
sir.
Was there a surplus or deficit at the end of the fiscal year?
There was we did not utilize all of our authorization. So,
So that goes back to the retirees.
well, what we do is we just don't draw it down,
Yeah.
so that it actually it stayed in the trust. So it continued to earn rather than, and we try to be very mindful of, because we draw it on a quarterly basis, and we would try to only draw what we project that we're going to need, because we would much rather it stay in the trust and earn a return rather than them being transferred into our accounts. So we.
The difference between prior budget of 17.3 and 15.8, I guess it is that simply a lessening of FTE positions, or is it a combination of?
Some of it is, some of it is just general savings. Some of it is, some of it I think is, you could ascribe to PIC, not having the PIC program anymore. And we've just been try to be very mindful of our expenses and our expenditures. Some of the things that we had budgeted for, didn't necessarily cost as much as we thought they were going to, which is, a good thing. So, but in the, I guess, the overall management of the budget, we've been able to, be very frugal with the amount of money that we've spent.
So over the last few budget cycles, has the number of FTEs remained
we've
right around that, what is it, roughly 50-ish?
The authorized have remained right around 51. The authorized have remained at 51, and then the filled have, kind of depending upon how many junior analysts we have and other folks, gone from about 42 to 46 or so. But that is that's my presentation in regards to the budget. There is Madam Chair, there is a motion in regards to the budget to the submission of the budget that's in your packet. I can read it if you would like for me to.
Please go ahead.
The motion would be the commission authorizes the CEO to submit a proposed FY 2019 detailed budget substantially similar to the draft budget presented for inclusion in the governor's annual budget.
Do we have a motion? And a second? All in favor? Aye. Ayes have it.
Thank you, Madam Chair. The only other item that I have, Madam Chair, is Andrew, I believe, has distributed to you your material interest form. And if you could, just a reminder to make sure that you sign that and get that back to him as soon as possible. Okay?
Okay. Thank you. I think next we have the CIO's report. Mr. Berg.
Thank you, Madam Chair. In light of the fact that we truly have a great deal to get through today, I'm going to exercise some discretion and step out of the way. I'll contribute throughout the day. I'm going to focus my comments on the agenda items as we progress through the day. So I'd like to keep the momentum going and invite David King to give us a recap of the fiscal year performance, as well as, I believe, a brief update as to where we are fiscal year to date.
Good morning. So, as Jeff said, I'm going to go a little bit more in-depth than we normally go through our fiscal year 2017. So you'll see a couple of new slides, and I'll explain them as I go through them. If you have any questions, please stop me and I'll be happy to answer them. So looking at our plan performance, for the fiscal year, we ended the year with an 11.88% return, beating the policy benchmark of 11.82 by 6 basis points. During this period, we paid $1.1 billion in net benefit payments. Looking at the performance in dollar terms, you can see that we've grown our asset base to $30.1 billion, with $3.3 billion in investment gains. And again, that's after paying out $1.1 billion to beneficiaries. This next slide, we typically show a table of numbers showing our portfolio exposures versus the SIOP compliance bands. So the top bar would be the upper range, the bottom bar would be the lower range. And the blue X is our policy allocation, or the blue X is our actual allocation, and the red dash is our policy. So you can see we're within all of our compliance bands with an overweight to public equity and an underweight to GTAA in our non-portable alpha hedge funds. This is partially because we're at the last day of the fiscal year showing these exposures, and we're on the portfolio glide path to our fiscal year 2018 targets. So when I show a July update, I can show you that we come back within those lines starting in the first month of the next fiscal year. This next chart just shows the market value of the trust through time since RSIC's inception. So you can see when we were created, the plan value was $25.6 billion, and it grew to about $29.5 billion before the financial crisis in 2007. And we have this fiscal year recovered past that previous high, grown the assets to $30 billion. And I think it's also important to point out that throughout our existence, we've paid $11.2 billion net benefit payments. We felt it was important now that we are also judging ourselves based on our peer rankings to show a slide in the presentation, so this will be carried going forward. You can see this middle line is a 50th percentile, so that would be the median peer return. And the blue line is our rolling 12-month percentile rank. And the yellow line is our fiscal year-to-date percentile rank. So you can see we started out the year kind of at the bottom of our peer rankings and have slowly grown up, giving a little bit back in the last quarter. And when I get into the performance, you'll see a little bit as to why that's apparent. So the last time I presented to you was April performance, and the plan had about 80 basis points of excess return. So I'm going to spend a little time and explain what happened and why we gave some of that back up. You can see in the last quarter, our excess return deteriorated, and this was partially because our private equity benchmark continued to rally faster than our marks could keep up, as well as commodities. We had a commodities implementation benchmarked against 50% MSCI World, 50% Barclays Aggregate, which the public benchmark did very well, and commodities continued to underperform. So looking at the absolute performance, you can see public equity, equity options, private equity, mixed credit, and private debt were all within double-digit returns for the year. And then the interest rate sensitive assets, so core fixed income, public real estate, and world infrastructure were negative for the year. Kind of switching gears and looking at excess return versus the policy benchmarks, you can see our portable alpha hedge funds were the highest excess returning asset class at 6.4%, followed by EMD and mixed credit. And on the other end, again, as I mentioned, this other opportunistic asset class was our commodities implementation. So it performed negative versus a benchmark that was very positive at negative 13.7%. And then our private equity benchmark in that last quarter just continued to rally So there was a negative performance of 4.67. Yes.
Just want to offer an update on this. Well, first, a little history. As you recall, we eliminated the commodities benchmark as the yardstick because what I wanted to do was apply pressure to force us to have conviction. If we're going to hold commodities, it shouldn't be an always-on kind of positioning for us. The update since the end of the year is we have gone ahead and eliminated that long exposure to commodities. We have replaced that with Bridgewater All-Weather, which used to be on our GIA portfolio. We've made that the holding tank for when we eventually consider investing in things like the insurance strategies or CTAs or things like that. So we have eliminated that considerable basis risk between a commodities benchmark and a 50% stocks, 50% bonds benchmark, because we just, frankly, it's excruciatingly painful to live with that variance. And it does not match an underlying level of conviction. So we've gone ahead and, for the time being, we're moving away from that.
Thank you. So looking at our absolute return on the x-axis and our relative return on the y-axis, you can see most of the asset classes are well within the positive territory. And again, our core fixed income, so our core bonds, performed slightly negative for the year. Our public real estate was slightly negative, and then our other opportunistic was down 5%. And then the last slide I'll show for fiscal year 2016 is our attribution or our contribution to the plan's excess return. You can see our portable alpha program. So this overlay collateral was very successful. It added 70 basis points of excess return to the plan, most of that driven by the portable alpha hedge funds. And you can also see emerging market debts and our non-portable alpha hedge funds also did very well this year. And again, that other opportunistic detracted 39 basis points, as well as just the private equity benchmark surpassing the marks we got in for the asset class for the year, which was another 35 basis points. And you can see those same numbers visually, with the blue bars being the selection effect, the gray bars being the allocation effect. So before I jump into a quick update for July, I'd like to pause and ask if there's any questions.
Not necessarily a question, more of a comment though, and a commendation to Jeff and Mike and staff. I think that the work that you've done on, realigning the portfolio and reevaluating everything, not just relative to our policy, but relative to our peers, our rankings have improved dramatically, and I think that shows in the results. I know that it will still take more time to get the overall portfolio moved, but narrowing that gap in our performance relative to our peers has been a tremendous achievement. So, my recommendation to staff.
So moving on to our July 31st returns, you can see we started out the fiscal year strong. The plan returned 1.93% versus policy benchmark of 1.63. And we actually have a positive net benefit payment, so money came into the trust because of a one-time payment from the legislator. And you can see that visually here. So the plan started at $30.1 billion. We gained $22 million of net benefit payments and then earned an additional $609 million. And that's all I have for July performance. Just running a quick benchmark performance estimate, the plan was up around 3.6% through last Friday. Just looking at our policy benchmarks. Yes. Thank you.
Would you remind me what the what the positive net benefit payment means again?
Yes.
Or Peggy, either one of us. Dr. Wilder, from the general, the employer contribution rate increased by 2%, for this fiscal year, and the General Assembly appropriated money to offset 1% of that 2%. And it's my understanding that all of that 1% that they appropriated came in at one time. So that's why there's a net positive, in regards to the benefit payment for July. Because that money came in July at the beginning of the new fiscal year for the state, so that, which more than offset the money going out, for that.
That's a big surprise compared to past charts.
Results not typical.
$18 million, so coming in all at one time versus throughout the year made a big
Oh, yeah.
impact in that 1 month.
It won't stay positive. That number will stay positive.
And frankly, as a reminder, we are approaching the part of the year where Terry is going to really start to unwind and cause an appreciably different story to occur. So we'll keep you abreast of that.
But I think, we'd be remiss if we didn't, I think mention just how significant of a commitment that the General Assembly has made to the fiscal health and stability of the plan. I mean, if you think about, just 1% more than offsets 1 month's worth of contributions, and they're putting in an additional 7% over time. So that's a, significant fiscal commitment on their part to the stability of the plan. So.
Mike, the unwind of the Terry program in terms of total amount is what, 3 billion on?
Additional 700 million, I think, coming out this year above.
We have a big amount that'll come out in December,
Right.
and then another large payout for the very last group of Terry participants next July. So I think the combination of those two is probably closer to $1 billion. I know we've sent the cash flow information over to Investment Commission staff.
Right. Well, it's usually about 200 million a year, and then there's an additional 700 or so or more on top of that. So it's $1 billion flowing out
About $1 billion, and
over
that'll be
the, I
over
think,
the
or,
next
yeah.
2
It's
years?
right,
It'll
over,
be between now and next July.
Next
Right.
July.
Right.
So-
Okay, and that'll be the end of it.
yes, sir.
So some of it will flow into next fiscal year because the last of the Terry participants will end their Terry on June 30th of
Right.
2018. So those payouts will probably occur in July, maybe even rolling into the first part of August of next year, depending on when all the paperwork comes into us. But we've already sent all the projections, and I'll be happy to send an email out and let everybody know what those amounts are. But the biggest increments will be coming in December and then next July.
And that was, when we talked about back in the spring, when we talked about some tweaks that we made to the asset allocation, it was in preparation for, because we've received the projections from, PIBA and working with them, it was to plan for, this much departure from the plan. So.
Is it in the form of an actual cash payout?
It is. From an accounting standpoint, those benefits have been accruing in the system. So if someone's been in Terry for 5 years, that's 5 years' worth of benefit payments that have accrued in their account that gets paid out at one time, either to the individual or rolled over into another qualified plan. But it still is money that has to be paid out of the trust fund.
And this is the rationale for why we are going to temporarily have in our policy target an elevated cash balance, so that we can build the liquidity and then manage that pretty effortlessly from our perspective. Any further questions for David? Okay, thank you, David. Next, I'd like to introduce David Hutchings from Alborn Partners. David is a partner of the firm. He joined Alborn in 2006. As you know, we made the decision last year to make a strategic change to the way we utilize consulting services. In addition to Makita, who's joining us today, we have decided to secure the services of a specialty consultant for our private markets portfolio. We conducted a very thorough search process during which we got to meet a number of really talented firms, and my internal appreciation to Ashley and Robert for spearheading this project. In the end, we selected Alborn, and I wanted to have them here this morning to introduce them to you, and I've asked David to give you a brief introduction and overview of the firm. So, thank you.
Chair, lady, gentlemen, good morning. It's very nice to meet you. I speak very quietly, so just to make sure you can hear me in this room. We really appreciate your time here this morning. I know you've got a very big agenda, so we can talk for very, very briefly initially just to introduce ourselves and touch on a couple of points. And I'm going to let Kathy start off. Right?
Hi, my name is Kathy Rossi. I'm a partner and client relationship manager with Alborn. I've been with our firm since 2004. During the RFP process, I was very instrumental in coordinating meetings, conversations, the share of information and data with your group as well as our team. Now, my role going forward will be to check in and to ensure the service that we provided, the service that we agreed to during the RFP and contracting stage is the service that you'll receive. We want to make sure that we're the best partner and a true extension of your team. And we're really excited to be working with you guys.
Hello, my name is Andrew McCulloch. I'm a partner and portfolio analyst at Alborn. I'm one of 3 portfolio analysts assigned to work with South Carolina. And I just wanted to mention, we see a lot of RFPs coming in each year. We try to be selective to those that we feel we can actually add something special to, where we can really complement the relationship. And while most RFP processes in our experience can be somewhat antiseptic, somewhat sterile, that was not the case here. It became clear very quickly from speaking with Ashley and Jeff and Mike and Robert and the rest of the team that they were interested in asking deep and probing questions, very targeted. They were very interested in making sure that we were absolutely the right fit for them. So we had multiple phone calls, one-on-one, multiple phone calls as a group, video calls, ultimately culminating in a 4-hour on-site meeting where we had the privilege of hosting the entire South Carolina team and learning directly from them, what it is that they need from us. And so we wanted to, after that meeting, having a conversation internally, we realized, these really are our sort of people. We really are a good match here, and we think we have something special to offer. So thank you very much for the appointment.
So let me come back again. So I'm David Hutchings. Though I spent most of my life living in the UK, I've now sort of settled in San Francisco. I haven't quite learnt the language fully just yet, but I'm working on it. So let me just reiterate our thanks. Really appreciate this point. It was a really fascinating process, an unusual process, and very insightful. And great thanks to sort of Mike and Jeff for giving us a great insight on what they wanted to achieve. I just say I think a special mention should go to Ashley. I know she's not here. She was very tough indeed, but very professional and very helpful. And though she's not here, that should not go unsaid. I wanted just to compliment you, by the way, in your banner headline, it has beneficiaries first. We see a lot of public pension funds around the world, and quite frankly, that gets lost in many cases. So I think it's really good to be up there. It actually resonates with us well, because within Alborn, one of the founders gave us a mantra which we live with, which is very much, don't take yourselves too seriously, but take your clients very seriously indeed. So a very similar resonance. I think it's great to have it there. It resonates with us very strongly. So we look forward to working with you and supporting your staff going forward. So you're going to see one other little thing. The first few weeks, I should say, working with staff has been great. It sort of confirmed all our expectations and judgment, and we look forward to time going forward. Happy to answer any questions, but I know you've got a very big agenda. Maybe we get a chance to talk at greater depth about this. We're very passionate, so we can talk for ages, but we won't do so right now. Right? Thank you for your time. Yeah.
Thank you very much.
All right, so Steve is going to kick us off with investment recommendations. Now, Steve's going to walk us through 3 manager recommendations for our GAA portfolio. But as we think about it, we think about a single restructuring recommendation. And we had goals for this restructuring that we've undertaken, and three main goals I think are important to think about as we hear from Steve. First, what we really wanted was we wanted a portfolio with a more consistent performance profile. While our returns over the last 10 years have beaten our benchmark, we're not satisfied with what we see in terms of consistency. To wit, that is a portfolio that has underperformed over the most recent 5 years. The second goal is to create a new framework that offers better alignment with compensating the manager. And we wanted to structure the arrangement with a very low base management fee, but with upside for performance, and more specifically for long-term performance. We think that we're recommending a really thoughtful solution in this regard. Steve will give you the details, but we don't want to pay anywhere in our portfolio high active management cost for the hope that we earn attractive returns. So furthermore, I mentioned we wanted to pay for sustained performance, not for short-term success. In this regard, I'm quite pleased with these managers' willingness to work with us down a new path. And then the third goal really relates to having a more strategic relationship, and we're not talking about a strategic partnership here in the sense of what we've done in the past. What we're talking about is these firms are agreeing to work as a partner to us as we tackle our challenges. So whether we're thinking about our tactical asset allocation decisions, whether we're engaging in challenging beliefs exercises, we've been very straightforward with our expectations, and these three firms have certainly risen to meet that challenge with us. So with that, I want to let Steve, hopefully I haven't taken too much of your thunder here, so go ahead and share with us your work.
Thanks. Yes, as Jeff mentioned, we're calling this the Global Tactical Asset Allocation Network, and so with that, we'll be recommending three managers here today. First, before I get into it, I wanted to thank the team, Justin Young, Chris Alexander, and Colin Bernier, for their help on this project. We did a tremendous amount of due diligence across 10 different managers to arrive at three, so many thanks there. The plan for today that I had for the presentation was to provide a brief background on GAA, the portfolio and how it fits within our broader total plan, review the goals and objectives of the search, explain the investment rationale and how we came to selecting the managers that we did, explore or illustrate how the portfolio comes together, and then lastly dive deeply or dive briefly into the teams that we're recommending. So with that, I'll start with the recommendation, up to 4% allocation to each Morgan Stanley, PineBridge, and Standard Life. All will be structured in a fund of one. We've negotiated operating expense caps of 10 basis points as a pass rating by our operational due diligence team. And as Jeff mentioned, a key tenet to this search was to have a low management fee, create alignment through a performance fee, not only paying when they outperform, but also over a rolling 3-year period to pay for sustained performance, and then also create an all-in fee cap to help control excessive risk taking at the portfolio level. What I'm showing here is a blended portfolio fee, management fee of 29 basis points. This is an 88 basis point hurdle rate over a blended custom benchmark, which will effectively be our public markets benchmark. Performance fee of 11.25% and an 87 basis point all-in fee cap. I think to put some context around the 87 basis points, in order to hit that target, the portfolio as a whole would have to achieve 750 basis points of annualized return over a 3-year period. And that's excess return. So that's a fairly lofty goal in order to achieve the 87 basis points of the max cap. So likely be coming in at a place well below that. But if we get there, I think we'd be pretty happy. Running through the strategic anchors, we aim to enhance value from the knowledge transfer of the partnership-like structure, improve plan performance through a 300 basis point excess return target net of fees, but also have excess returns that are diversifying source of excess returns to RSIC and our current plan. and promote confidence through this economic alignment that we've created through the fee structure. Looking at where the GAA allocation sits within the portfolio, it's within a 13% allocation to opportunistic. That's comprised of a 3% allocation to other opportunistic, 2% to hedge fund non-portable alpha, and then the remaining 8% is to GAA. The current benchmark is a 50-50 stock bond portfolio.
The opportunistic, the 3% that you were talking about, what sort of things would that be?
So Jeff mentioned this earlier. This was the commodities portfolio that we had. And so now this is outside the GAA, but the opportunistic would be things like reinsurance or CTAs, really stuff that doesn't fit neatly into the broader portfolio, that either is going to achieve north of 7.5% return or be diversifying to other plan assets that we have. So at the onset of this search, the objectives were, we wanted to add 25 basis points of excess return broadly to the plan assets. So at an 8% allocation, that arrives you at the 300 basis point portfolio target excess return. And we wanted to do so with a 300 to 400 basis points of tracking error. We'll measure and judge this success over a 3-year rolling period. At the individual manager level, you'll notice that the excess return target is 400 basis points, and the tracking error is a little wider at 500 to 600 basis points. This is really a result of the diversification that you get across the 3 managers and that they're lowly correlated with each other. And we'll measure these portfolios over 3 and 5 year period, given that we're looking at them at a one-off instance for each manager. And then lastly, we'd like to evaluate the non-financial performance or the value add through the partnership-like structure on an annual basis, providing scorecards back to the managers, but likewise asking them to rate us as well. We started off with 10 managers, as I described earlier. We did a custom RFI and evaluated them on the following criteria. All of them, we believe, hit this criteria, but mainly we wanted consistent excess return generation from tactical asset allocation, and we wanted that excess return to be diversifying to RSIC plan returns, but also not dependent on just being overweight risky assets. We wanted them to have full range of products and services, so instead of going out and buying a high-yield ETF, they're going out and actually buying the high-yield bonds in markets that are less efficient. And then from the value add perspective, wanting customized research, ability to share meaningful resources with us, access to their senior team as a way to help be an extension of our staff. And then lastly, creating economic alignment, which we think we did. These investment considerations go across all 3 managers with one specific to Aberdeen Standard Life. The first being active drawdown risk. Given that each manager has a 500 to 600 basis point target tracking error and a 2 standard deviation move, this can be material underperformance relative to the benchmark. We'll touch on how we think this is mitigated later on in the presentation, but wanted to make everyone aware of the wider tracking error results in wider expectations or bands of expectations. Paying performance fees in a negative return environment, given that this is a performance fee paid over a relative beta benchmark, there's an opportunity that we could pay performance fees when the absolute return of the portfolio is negative. Key person risk, we don't believe there's any reason that any of the portfolios would leave, but this is something that we would want to keep track of if someone were to depart and want to reevaluate the portfolio. And lastly, the Aberdeen Standard Life merger. This is something that we will continue to monitor, but as with any merger, there could be disruptions from business integration. We did an overlap analysis. We think that the Standard Life Aberdeen multi-asset businesses don't overlap too much and are comfortable with it, but nonetheless, we'll continue to monitor on a quarterly and annual basis. Thinking about how the portfolio comes together from a qualitative perspective, illustrating the diversification across time horizon as well as tactical asset allocation skill set. When I say time horizon, it's the average length of the tactical asset allocation trade idea. So what's the time horizon that they think they'll add value from their active portfolio? Morgan Stanley, PineBridge, and Standard Life, you'll see are diversity of 1 to 6 months. They also look at kind of 1 to 5 year longer thematic trades. 6 to 18 or 9 to 18 months more medium term, and then 6 to 12 kind of a little bit on the shorter end. So you're seeing diversity across implementation idea. And then secondly is how they view tactical asset allocation. We're using level 1, level 2, and level 3 as a way to describe the different levers that they can pull. Level 1, if you think about it in the context of RSIC, would be global equity versus core fixed income. Level 2 would be U.S. equity versus emerging market equity, and level 3 being maybe Chinese equities versus Brazilian equities. So when we look across the board, Morgan Stanley is predominantly pulling on lever 2 and 3, not really making that big risk-on, risk-off decision. Standard Life as well, there's a little bit of broader risk-on, risk-off decisions being made, and then PineBridge focusing more on the level 1 and level 2. And then lastly, while they're doing things differently, they're having the same type results of having low excess return correlation to our historical RSIC excess return, as well as a standard 60/40 risk benchmark. So qualitatively, they're doing things differently. They have varying processes and time horizon, but I think when you look at it from the number side, it shows through in a fairly lowly correlated excess return stream of 0.616 and 0.45, kind of the range. So assuming there's no benefit of correlation when looking at the risk of the active portfolio, you would assume the portfolio to be 600 basis points of tracking error given the 600 basis point target tracking error. Because of the diversification, you see about a 30% reduction in tracking error, resulting in about a 430 basis point target at the portfolio level. So that's a way that we feel a little bit more comfortable about the mitigation of risk of the active drawdown of any one individual manager, because they will be operating fairly differently than each other. But in addition, we wanted to test to make sure that an equal weight to each portfolio and building the portfolio was the appropriate way. And what we're looking at here is the contribution to active risk, and you see about 1.3, 1.5, 1.5. So no one manager will really be steering the ship if they have a bad year or a really, really good year. So I think correlations are nice, but I think looking at the calendar years just helps you to realize, like, what would this feel like from our seat? So looking at 2008, 2009, and 2016, probably more choppier years, you can see that the managers had some diversification. 2 are up, 1 down. 1 up, 1 flat, 1 down, 2 down, 1 up. So you're getting kind of that visual diversification of across different marking periods. When we look at the active risk or active drawdown risk of the portfolio, fairly lowly correlated on the drawdowns to a broad 60/40 portfolio. This is their excess return streams. Right now, currently in an active drawdown, but are starting to chip away to get back towards the benchmark return. For context, this is down about 400 basis points. It would be about a 1.5 standard deviation move. I'm going to move on to the managers and do a brief overview of them. But I think thinking about all 3 managers as a whole, they're all fundamental managers in this space that we looked at and that we are selecting. So what I'm going to try to do is highlight how all 3 managers are different and what's unique about them as I go through these slides. So Morgan Stanley Investment Management is a global macro and thematic investor, and they focus on 2 key themes. One is macro shifts and the other structural transformations. A macro shift is something that they think is a 1 to 6 month time horizon. Think changes in rates, changes in growth, changes in inflation, more fast twitch type data, and how that impacts markets. Where structural transformations would be more of your 1 to 5 year time horizon. In that case, think tech versus retail or emerging market demographic changes, China growth, et cetera. The way that they're different and unique about their active risk budgeting on their tracking or on their tactical asset allocation decisions is this development of tactical thematic investment ideas. They'll develop 5 to 6 themes at any one time within the portfolio and execute them with 3 to 5 trades per theme. And they aim to have a 50% hit or success ratio on those trades and seek an asymmetric payoff profile. So make more money when they win than they lose than when they don't win. They identify these themes by looking for valuation and sentiment extremes. So from a valuation perspective, 15 percentile, 85th percentile, and wider, as well as sentiment being overbought or underbought. The team is run by Cyril Moulet-Berteau, and if he's watching, I apologize, probably butchered his name, but he's the ultimate risk owner, 26 years of industry experience, and supported by Mark Bavoso, Sergei Parmenov, 21 years and 31 years of experience, and 16 dedicated multi-asset team members.
Give me an example of a theme. I want to see how big that is.
Yeah, so like European recovery is one that they're bullish on. So maybe what they do is they'd play the currency, they'd play European banks, and maybe short domestics or exporters, depending upon how they want to play that. So, I mean, they're going to play take multiple bites of the same apple, just with different implementation methodologies. And when they aggregate it, and this is what we're looking at on this chart, where they aggregate and track all their trades by the theme, so they code them. So when we went back and looked at the attribution, over the past 5 years, I think they had 75 different themes throughout the portfolio through that time period. And on average, 52% of those themes were positive. When they were positive, they made 18 bips. When they're negative, they lost 14. So about a 1.4 upside downside ratio, as a way to kind of illustrate how they're making money over time through these themes. But back to the top of the page, the excess returns in the blue line here, you can see over a rolling 36-month period, adding value 92% of the time. And the red line is the rolling 36-month 60/40 portfolio, seeing that it's fairly lowly correlated with a broad risk portfolio. To move on to PineBridge, again, a fundamental investor, taking an intermediate term horizon, knowing that in 9 to 18 months, or their belief is that's when markets become inefficient and will move back to fair value. What's different or unique about their process is that they leveraged 20-plus specialist teams across the PineBridge network. We'll have 20 quarterly meetings and use the insights that they extract from their leveraged finance team or their commodities team to create forward-looking return and risk curves or a capital market line. That then informs how they construct their portfolio and also helps to inform how they apply a risk-on versus risk-off position in the market, which we'll show in the two slides forward. But the ability to make that broader macro view of we like risky assets or we don't like risky assets is something that's unique to PineBridge and comes through their process. And then the last piece of it is they implement through their active managers or passive, depending upon the efficiency or inefficiencies of the underlying markets, and use the PineBridge teams. The team's led by Mike Kelly. He joined in 99, 20 dedicated professionals, and the top 5 senior team members have approximately 20 years of industry experience. So similar chart, looking at the rolling excess return, rolling 3-year period, outperformed the benchmark 89% of the time, and actually negatively correlated with a 60/40 portfolio. When we look at the source of their excess returns, the large majority comes from allocation or tactical allocation decisions that they're making around the benchmark, with a fairly steady value add coming from manager selection, and that's the use of their underlying teams. I thought it was worth including this chart, and there's a lot going on here. I'll try to simplify it, but to help illustrate how they're making those broader shifts throughout time. So this chart here is 2007. It's their capital market line. So this is return. On the left axis on the bottom is the volatility. So when you have a moment of time when the volatility is really high, but return on a forward-looking basis is low, investors are not rewarded for taking risk. So therefore, what they did is shift their portfolio pretty significantly to a 30% allocation to cash, reducing equities. In 2009, the opposite was true, and investors were handsomely rewarded for taking risk, and therefore you see this cash reduced from 30 down to about 0 with 30% plus allocation to equities. They track these and create these capital market lines on a quarterly basis and could be very insightful to us as well internally. It's how we think about broader portfolio positioning. They saw again back in post-Brexit that investors were too pessimistic and that actually risk was being rewarded and added equities, which fared pretty well. Lastly, Standard Life. Their focus or philosophy starts on a focus on change. It's their idea that fundamentals ultimately drive markets, but it's when things are changing, that's when it creates opportunities. And that kind of permeates through their broader investment process, whether at the macro team or the underlying bond or equity team that across the firm. What's unique about them, they develop a house view. It's a top team of senior investors, 30 years plus investment experience. Those views permeate down to all the underlying strategies. The team that will be running our portfolio is the GTA team. They're asset allocation practitioners and strategists. They form views on 28 global liquid markets, and then translate those views into a portfolio with Adam Rudd, the portfolio manager, as well as an implementation desk and investment risk team. Guy Stern runs the group. He joined in 2008. The GA team has 8 people. There's 11 strategists broadly at the portfolio or at the company within the multi-asset team, and then 8-person implementation desk helping with building and constructing the portfolio. Again, similar chart that we're seeing, looking at the rolling excess returns of Standard Life on 36-month basis, rolling basis, outperformed 0. This is a excess return over LIBOR 100% of the time. It is gross, so we can haircut this a little bit. That said, still very lowly correlated versus a 60-40 benchmark and adding value fairly consistently. The chart below illustrates the sources of excess return coming from corporate credit, equities, property, and cash and fixed income. And you see government inflation and EMD being slightly negative over the time period. Thought it was worth putting a chart here similar to Morgan Stanley, but looking at their hit rate, because that's how they think about their success within a market, when they own it and when they don't own it. What you will see from this is that these are the 28 markets that they trade. 64% of the time over the time period, they were correct. And when they're correct, we're right 58 basis points on the upside. And when they were not correct, lost 29 basis points, illustrating that asymmetric return profile of picking markets. Before I close, I think wanted to spend one slide on the network and what we're hoping to extract from it. Jeff alluded to some of the things. But we coined this on the RFI as something more than a mandate. We just don't want them to come and run money for us. We wanted them to be a strategic thinker and thought partner for us. So that said, there's 4 things that I think we're really going to get from this. One is a tactical asset allocation partner, or 3 of them, with the ability to look through the portfolio. We're giving them our portfolio benchmark, so any of the decisions that they make effectively mimic the decisions that we can make. And also as an extension of staff to evaluate allocation or trade allocation ideas. As an example, we thought retail REITs looked attractive a couple months ago, and we gave all 3 managers a pop quiz. Within 2 to 3 days, they came back with a full deck on how they thought the market was, how they would play it, if now's the right time, or maybe it's kind of a wait and see. And so those types of things we could use on a weekly, monthly basis and have contracted them in or will contract them into the agreement. The other piece is the more strategic research partner being, as Jeff alluded to, challenging beliefs type projects, contracting in 2 to 3 projects per year. They can be a third-party voice, or they could work collaboratively with us, or in opposition to the way that we're thinking about things, as a way to give an outsider's view, or perhaps manager A versus manager B, and seeing how they both think about the same problem. Third is as a training partner, providing access to their firm training research sources, on-site training, whether that's going up and sitting on their trading desk or meeting with underlying teams. And then lastly, coming down to RSIC and helping do teach-ins here on specific topics. And then lastly, the high frequency of communication ultimately results in greater transparency, would be a higher touch client with greater knowledge transfer, and the ability to have frequent dialogue with the key decision makers at the firm to see what they're seeing in the markets. So I'll close with the recommendation, again, allocation of up to 4% to each of Morgan Stanley, PineBridge, and Standard Life in a fund of 1 structure with 10 basis point expense cap. It's a pass rating by our internal ODD and a blended fee structure, 29 basis points, 88 bips over a benchmark hurdle, market benchmark hurdle, and then 11.25% performance fee calculated on a 3-year rolling basis with an all-in fee cap of 87 basis points. With that, I will pause and take any questions that you may have.
Are we increasing our portfolio allocation to GAA at this time, or is this just a reallocation within that category?
It's a reallocation within the category. However, a large portion of our portfolio is synthetic right now, so this will give us the opportunity to have active returns in the space.
So I take it then a good bit of the funding of this would come out of Bridgewater current allocation?
I alluded to this briefly, and what we did when we reduced our commodity exposure was we made that sort of the home base portfolio for the other opportunistic, rather than having this enormous kind of tail risk versus our benchmark. So we've moved the Bridgewater exposure to fit over there now. And so right now what we have is we have 1 active mandate, and we have a high use of the overlay. So passive implementation right now. And this would replace that.
And in terms of risk, risk versus return versus risk, would a Sharpe ratio show that this is preferred to the 50-50 or 60-40 benchmark?
Yeah, I think from the portfolio context, it's probably like a 60-40 or a 65-35 portfolio, because if you think about our public markets portfolio, we have a lot of credit in there, which is effectively an equity proxy and EMD and some other things that push us probably a little bit more away from a 60-40. But this is in line from a Sharpe ratio perspective, and hopefully better, given that there's the active component, and that being diversifying to the risky assets would reduce volatility is the hope. That said, the active return can be time varying, or the correlation can be. So there can be periods of time where it's highly correlated with risky assets, which could be the right decision to make, but that would could potentially increase risk in the portfolio.
So this is actually feeding into a recommendation that we want to work on with Makita going forward. Right now, the benchmark for our GAA strategies is 50-50. And since this is largely going to be challenging these firms to have a cross-section of our public markets portfolio as a benchmark, I think it makes sense for us to consider that as a benchmark change for our asset class. For two reasons. One, I think that helps put them in the seat that we sit in. As they contemplate changes, those are changes that we should have that discussion with them, so that we should they think it's a terrible time to have equity risk. We should have that conversation. We should understand and contemplate that as to whether or not we'd like to make a corresponding change to our portfolio. Second is I just, and this is going to, I think, maybe be a little strange, if they have that cross-section of our portfolio, effectively, there is no GAA as an asset class, because it is all of the pieces in the proportional amounts of the rest of our exposures. So GAA is an implementation at that point in time. It's not really a standalone form of risk. It becomes an active, tactical vehicle to deliver excess returns, which is separate. It's a different lever than the levers that the rest of our managers pull. So I don't want to go too much inside baseball, but making it look from a benchmark perspective like the rest of our portfolio is something I'm interested in exploring, but I want to explore that with Makita leading into the December meeting, when we start contemplating asset allocation and benchmark changes. So.
Yeah, sometimes they say GAA and sometimes GTAA. Is that just random, or is there a distinction between those two?
I'd love to be able to say we're very disciplined about that, but the way I would have you think about it is the reason why we have all this is we always wanted to refer to Bridgewater All-Weather differently, because that's risk parity. So we had risk parity and GTAA as the two flavors of strategies, and we thought of GMO, and if you recall 10 years ago when we had Mellon, we thought of those as GTAA strategies, and we had risk parity. The umbrella over all of them was GAA. Not sure that helps, but
Random.
yes. Any further questions for Steve or me?
If not, we have a rather lengthy motion, which I will go ahead and read, and then if someone would like to so move, I would appreciate it very much.
Reading of the motion and adopt the motion as written.
And,
do we need to put it on the screen, or are we good with that?
It's been posted.
yeah,
Okay,
yeah,
you're good with that?
We've seen
Okay.
them in writing, so I'm okay.
Okay.
discussing with it.
Well,
Just one quick point, Madam Chair. It's
Oh,
my
yes.
understanding that Mr. Giobbe, given that he's retired from Morgan Stanley, receives a pension from Morgan Stanley, pursuant to the Ethics Act, would like to recuse himself from the vote on Morgan Stanley. So as to Mr. Giobbi, I believe he would just want to vote, his vote to reflect, because we're doing this as a group, that he's recusing himself from Morgan Stanley, but the other two, he would vote on the other two. Does that make sense?
Yes.
Yes.
Okay, so is there a motion that we adopt the pre-written set of motions for these three investments?
So moved.
And a second. All in favor? Aye. Aye. Looks like the ayes have it.
There you go.
Thank you.
Yes.
I hope that the sense of urgency is clear. Steve ran through 3 managers and an umbrella very efficiently. So that only raises the bar for Derek Connor, who is going to, we now are entertaining a private equity investment with Francisco Partners. Francisco is a buyout and growth equity firm focused on the tech sector. They do have, to me, a unique approach to tech investing that I argue is not only prudent but timely. In the public markets, as Derek will show, tech has been a very strong performing sector for the last 5 years in particular. And that type of environment is one that is very difficult for a private portfolio to perform against. Part of Francisco's process is to take this very value-oriented approach, and he's going to walk us through how that looks. I've discussed before, and I want to express this as an aside. I've expressed a desire to make more meaningful allocations to our managers, and this has typically meant we make commitments of at least $100 million in private markets. However, in the case of Francisco, we don't believe we are going to be able to get this type of allocation because of just extraordinary investor demand. I would still like us to move forward with this investment for reasons that Derek is going to share with us, but I want to make sure I address that head on. So, Derek, please.
Thank you. Good morning, everyone. We'll make this fairly brief. The recommendation is to commit up to $125 million to Francisco Partners Fund 5. We have received investment due diligence and operational due diligence reports from our private markets consultant, Alborn. Francisco received a pass rating from our internal operational due diligence team, and we are in the final stages of legal negotiations. And should this investment be approved, we're targeting a close of tomorrow, so pretty quick turnaround. Going into the manager's background, Francisco was founded in 1999. They're based in San Francisco and focus on buyout and growth equity investments in the middle market space within technology. In 2004, the firm opened a second office in London, primarily to source deals in Europe and to a lesser extent Israel. They have a very deep team, 45 individuals focused exclusively on the technology sector. And within technology, there's 6 subverticals that they specialize in. And they have a very strong leadership team. DJ Deb is one of the co-founders of Francisco. In 2005, he was inserted to the role of lead partner and CEO. And in 2015, the firm announced the promotions of Deep Shah and Ezra Perlman to the positions of co-president. And this is really to help alleviate some of DJ's management burden and allow him to focus a little bit more time on the investment side, which we view as something positive. And lastly, Francisco has a dedicated relationship with Francisco Partners Consulting, or FPC. FPC is Francisco's independent consulting arm that works closely with Francisco portfolio companies to help in the value creation process, implement operational improvement plans. And this is a team of 11 individuals. 5 of those individuals are CEO level resources, so they have experience running companies in the tech sector. And they have 6 functional experts in areas such as sales, human resources, operations, and finance. Going into the investment rationale section, we believe Francisco's demonstrated attractive long-term performance. Its 2 most recent funds are in the top quartile. We like the access that we'd be getting to the middle market technology industry. Technology is one of the most dynamic and fastest growing industries in the global economy. And we like the middle market just given the broader universe of companies to invest in. And we define middle market companies as those with less than $1 billion of enterprise value. And if you look at, for example, publicly traded companies in the US, there's about six times as many companies in the middle market compared to companies above $1 billion. So we like that larger universe to invest in. Francisco has a very deep and experienced team. Importantly, they have experience investing in two significant recessions, the technology bubble in 2002, and of course the financial crisis in 2008 to 2009. And we like the specialization that they have. We believe this allows for the ability to develop deeper insights. They have very deep relationships in the industries that they cover, know a lot of the management teams on the companies that they target, and we believe this leads to a higher share of proprietary deal flow. And in the high purchase price environment that we find ourselves in, we believe that's attractive, and that should continue for Fund 5. Francisco, as Jeff alluded to, generally takes a more value-oriented approach to investing in tech. When they do not have control, they do approximately 20 to 25% growth equity type transactions, which are typically minority positions. They will structure downside protection through preferred equity, warrants, and debt. And over the last few years, as they've been finding companies to purchase, they have assumed that there would be a recession over their investment period. So this has caused them to be very disciplined on the buy side and use leverage generally pretty modestly. And then lastly, we like their flexible investment strategy. They pursue a wide range of transaction types, from traditional buyouts to corporate carve-outs and growth equity investments. Going to the next slide, the investment strategy. So Francisco primarily focuses on investing between $50 to $250 million in companies with enterprise values between $100 million to $1 billion. Most of their deals are in enterprise values between $100 to $500 million. However, if you look at their last 4 funds, there's typically a few outlier deals that are slightly higher than the upper ends of these ranges, and that's something we expect to see continue for Fund 5. Again, most of their transactions are control. About 80% have been controlled buyouts. The remainder is growth equity. They pursue what they call a barbell approach to investing in technology. On one end of the spectrum is value deals. These tend to be companies that are very mature, high cash flow generation. Oftentimes they don't have world-class management teams, so there's the ability to come in, buy the companies, upgrade the management teams, and generate attractive cash-on-cash returns. On the other end of the spectrum is growth deals, and these are typically businesses growing by at least 15% year-over-year revenue growth. They may have technologies that are disrupting markets, a need to expand into new geographies, and these investments provide the potential for outside returns. So we like the diversification that Francisco has between those higher growth and more value companies. The next slide, there's a lot of information on here. I'm going to delve deeper into the performance information on the next slide. But what I want you to focus on is Francisco's fund size growth over time. In 2006, they had a $2.4 billion fund. Their most recent fund is $2.9 billion. Fund 5 will be a bit larger. They're targeting $3.9 billion. But if you look over the past 10 to 15 years, and you compare Francisco's growth in AUM compared to some of their competitors, I think it's been very measured, and that's something that we see as attractive. The next slide, what this is showing is Francisco's performance on the basis of TVPI, or net multiple, for their 4 funds since inception starting in 2000, compared to the Cambridge Associates US buyout and US growth equity universe. And Fund 1 was a disappointing fund. That was raised 2 years before the technology bubble. Francisco had a different leadership team in place, largely a different strategy. Some of the mistakes they made was over-levering some businesses that weren't able to withstand the recession. They executed a number of minority investments without structural downside protection. So what we like is just the improving trajectory that we've seen in performance. Fund 2 is when DJ took over management of the firm, and part of his, when he took over, part of the things that he implemented, one was formalizing the investment process, applying more rigor to the underwriting process, limiting the use of leverage, and structuring downside protection on minority deals. And we think the performance has been trending in the right direction, and we're encouraged by the performance of Fund 3 and Fund 4, which are both in the top quartile. However, Fund 4 is fully unrealized at this time. It is a relatively immature fund, but we have looked at the underlying portfolio companies, and we believe there's a lot of upside in the fund's position to do well in the future. The next slide is comparing Francisco's performance versus two public equity indices. The first is the S&P 600 Information Technology Index, and the next one is the private equity policy benchmark that we use. Fund 1, we're discounting this largely because it's a different team and different strategy. And if you look at Fund 4, it's only 2 years in its investment period. A lot of the companies they have are very immature and still held at cost. So they haven't had time to implement some of their value creation initiatives. So we think Funds 2 and 3 are the ones that you should be focused on. And if you compare the performance versus the policy benchmark, it has outperformed. If you look at Fund 3, it's outperforming by 400 basis points. But remember, this does include a 300 basis point liquidity premium, so it's really 700 basis points. However, if you compare the performance to the tech index, it's a little bit more mixed. And I think that's largely due to the run-up that we've had in public equity markets overall, and technology more specifically, which I'll get into on the next slide. So what this is showing is the performance of the S&P 500 index versus the S&P 600 Information Technology Index over the last 10 years and 3 years. So what you saw from 2007 to 2013, the two indexes were trading within a very tight range. And then starting in about Q2 of 2013, we saw a pretty dramatic run-up in technology public markets. And that's really further illustrated on the 3-year chart. This is something that we don't believe is going to continue over a long time period. And we think Francisco is positioned, given their conservative use of leverage, broad investment in terms of industries they're investing in technology, to do well in a recessionary or sideways type market. And we think their strategy is more of an all-weathered strategy. Going to the next slide, I'm not going to talk much about this, but what it's showing is Francisco's loss rate, which is defined as investments marked below costs on the basis of invested capital. So over time, you can see Fund 1 had a very high loss ratio, 40%, and we've seen that come down significantly. So that's something that's attractive, and I think that really demonstrates their improved discipline on the underwriting side. Investment considerations, we do have some concerns. I think one of the biggest ones is the relatively large increase in fund size. Fund 5 is expected to reach their hard cap of about $3.9 billion. This will be about a 35% increase over the last fund. However, if you look at the 4 prior funds and the average transaction size over time, it's been pretty consistently between 100 to 125 million, which is what they expect for Fund 5. There will likely be a few outlier transactions, as I alluded to earlier. Another concern is Francisco does have a relatively large unrealized portfolio. There's 45 current companies, and they have approximately $5 billion of unrealized value. However, we believe that's mitigated by the size of the team. If you look over the last 4 or 5 years, the deal professional and senior deal professional per active portfolio company has stayed very steady. And remember, Francisco does have their consulting arm, FPC, that could be available and used as a resource to help on the monitoring side if the deal team is stretched thin. Fund terms, again, Francisco is expected to hit their hard cap of about $3.9 billion. The GP will be committing about 2.5% of the overall fund size. Management fee is 1.5% on the basis of committed capital over their investment period, which is a 6-year investment period. stepping down to 1.25% of invested capital post-investment period. 100% of the fees are offset against the management fee. I should say that fees that are paid to FPC will not be offset as it's a separate legal entity. Francisco has a standard 8% pref, 20% carry, 10-year fund life with 2 extensions at the GP's discretion. Further extensions need to be approved by the advisory board. And again, just a reminder, the recommendation is to commit up to $125 million in Francisco 5. And at this point, I'm happy to take any questions.
Are any of their investments in publicly traded firms?
They don't invest in, they sometimes acquire publicly traded firms and will take them private. And there could be a situation where they buy a company, it's private, and then they IPO it and take it public, and they could be in a lockup. But they're not going to purchase companies that are publicly traded unless they're taking them private.
Other questions?
No other questions or discussion? There is a pre-written motion, another lengthy pre-written motion. And if anybody would like to move as such, and if anyone would like to second that.
Second.
All in favor? Aye.
Aye.
The ayes have it. The next is the investment delegation policy, and I might ask if anybody would care to take a little break before we do that? Yes. Okay, how about we resume in 10 minutes? We resume our meeting. The next order of business is we're going to discuss an investment delegation policy. I think I will have Mike introduce it, and then he will introduce Makita. They have prepared a report on, a benchmarking report on it.
Can I ask one thing?
Absolutely.
Just because I'm going to have to step out here and rejoin by phone.
Yes.
If we could put the policy up for discussion and then bring Makita
Okay.
in as part of the discussion, because I have one thing I would like to potentially offer as an amendment
Okay,
Sounds
to
good.
it.
that sounds good.
Yeah.
So Kathleen, we completely reversed the order of what we told you.
I can get there quickly. There's a lot of pages.
There's lots of pages.
Doesn't start there, does it? No.
That's the.
No,
due diligence
that's, yeah.
guidelines. It's all right, we'll find it.
I know, I should have looked at it before I walked over
Nah,
here.
it's
I just got thrown off completely.
That's your into
I'll
the,
look.
you're into the thing.
I'll have to go back up here and look.
While we try to find the actual policy itself, first of all, I'd like to thank, there have been several people and entities that have been involved in the drafting of this policy. And, what's that? Okay. I'll let you drive. And, I think just kind of put this in context, I think this is probably one of the most significant policy changes that the commission will consider or has considered in the time that I've been here. And I think that this certainly represents a significant shift in the responsibility for really the implementation of the portfolio versus oversight and management of the asset allocation, and is really reflective of, I think, the change organizationally that we've been driving towards, allowing the commission to focus on the big picture items like asset allocation and asset liability, modeling, those types of things, versus providing staff with the ability and the authority to go out and find the best investment managers to implement the portfolio. And certainly the breadth of this policy, I think, cannot be understated. And I think that during this process, we have carefully considered what this policy, the policy as we have it proposed, what this policy should do in regarding delegating the final authority to invest to staff. I'd like to thank Makita for the work that they've done. As you know, in the pension reform bill, one of the components, one of the major components of the pension reform bill was the ability for, as far as we're concerned, was the ability for the commission to delegate the final authority to invest to staff of up to 2% of the value of the portfolio for publicly traded and liquid type assets, and 1% for assets that are not publicly traded or not liquid. And as also as part of that, the statute required us to consult with our general consultant in order to really get a kind of a broad look across the country as to what best practices are in regards to other pension funds that have delegated the final authority to invest. And Makita did a fantastic job of going out and looking at other pension funds and how they, really how they structure their delegation policies. Also, Dory and our legal staff did a fantastic job of doing somewhat of the same type of work of going around and trying to, really collect, policies and try to figure out what the best practices are. And as a result of that, Makita did a report which has been provided to you all. Certainly, they can chime in at any time. And the driving thought and intent behind this policy was to keep in place all of the protections, the policies, and the procedures that we have in regards to the way that we do investment due diligence and operational due diligence, and also the legal negotiations in regards to the contracts, to keep all those in place and all the steps of the investment process that we now have in place, but for bringing the recommendation to the commission for a vote. So we tried to capture really that entire process, and as I told you in some of the correspondence that I've given to you this policy has been drafted, that's why we provide a link to the latest due diligence policies in the document to make sure that we're capturing all of those steps, and to make sure that we have the latest the latest reflection of those policies and protections in the document at any one given time. You all have had the proposed policy. You've weighed in. I'd be remiss if I didn't thank you, Madam Chair, and Dr. Wilder for the work that you have done, both in collaborating with us and serving somewhat as a bridge to Makita and expressing your concerns in regards to this policy. This was certainly, from the drafting part of this, was a collaborative effort of myself and the members of my leadership team. The basics of the policy, I think everybody knows, or should be familiar with. Again, the goal is to keep in place all the protections that we have in regards to the investment process, but for the commission actually approving an individual investment. And for public markets, staff would be allowed to commit up to 2% of the total value of plan assets for those investments where the underlying assets are publicly traded and liquid. And in regards to private markets, the limit would be 75 basis points. I think, we would be remiss if we didn't go without saying, both of those percentages, 2% is the total amount that is allowed for the public markets by statute. 75 basis points comes under the authorization of you allowing us to have up to 1%. But those are significant. I mean, given that we have a $31 billion portfolio, both of those numbers are, when you translate those into dollars, those are significant amounts of money. 2% of the portfolio now would be over $600 million for public markets, and 75 basis points would be, north of $200 million. And also wanted to make sure that everyone understands that the reason that we expressed these limits, there's a couple of reasons why we expressed these limits in terms of percentages rather than in terms of hard dollar amounts. It's certainly not in any way trying to, obfuscate or not, or to not be able to create an understanding of how much these dollar amounts actually are. But given that the authorization is expressed in percentages, then, you know, expressing these limits in percentages dovetails with the authorization in the statute. It also, all of our other policies in regards to asset allocation, you know, the limits, the ranges and targets for our asset allocation are also expressed in percentages. The 25% limit on private markets and private market investments, are expressed as percentages. But that is not, so this policy does not set in any way separate and distinct from those other limitations in regards to ranges around asset classes and in regards to the overall limit on private markets, for example, but is really part and parcel of those other restrictions that we have in regards to the portfolio. So this would just simply be a method of implementation. I believe, you know, we believe that this process has been thoughtful, and you know, the one thing that you know, that I wanted to make sure that everyone understood when considering this is, you know, Jeff and I and others put a lot of thought into how this should be structured and what the limits should be. And what we really wanted to do is, you know, we like to believe that the commission has a great deal of, you know, of confidence in us and our forthrightness, and that we would not look to abuse this. But we also realize that this is given the kind of the monumental shift for the commission, that we're doing this policy not necessarily for the people that are sitting in the seats that we have, but we're really trying to look forward and think about, if other folks are sitting in these seats, what is a best practice to make sure that they're, you know, that they're fulfilling their fiduciary duty to the trust. So all that being said, so it was all done with that in mind. All that being said, if there's anything that, hopefully I didn't steal all of your the thunder from Makita, but if there's all that being said, if there's anything that we got to do to.
Up against your.
Yeah. Okay. So, but we have, for purposes of, you know, the minutes and the quote unquote record, we have received I believe we are in compliance with the statutory requirement that we consult with the general consultant. We've received a report from them. That report has been made as part of the public documents that are available in regards to the commission, and they have recommendations. And if there's anything that they would like to express, they're certainly willing to do so, and we'll take any questions or any other potential amendments to the policy. So.
Being that Alan has to leave, would you like to just go ahead and
Yeah,
discuss
well,
your?
the motion's not on the table, so we're not at the part. But I would just say in section 3, if we can just real quickly go here, right? The way this is written, it only covers the individual, but not the aggregate effect, right? So you could wind up having a series of transactions that would be compliant, right? But then would in aggregate be something quite different. I think there needs to be an aggregate limitation as well.
Well, the
Not just on a per investment, right? Because this says the size of an individual investment is limited to 2%, but you could have 3 individual investments, each of 2, and be at 6.
Right.
Well,
Right,
for example.
Sure.
Right.
And what I was trying to cover, and we can certainly make it more specific if we need to in the policy. But you know, this policy doesn't set separate.
The system has detected that this conference has reached the duration limit for
All right.
3 or fewer participants.
We're all done.
And will now attempt to close the conference.
Well, now
if you wish to remain in conference, please press any key now.
This policy doesn't, you guys set the asset allocations, you set the targets and ranges. And those are all reflected in the AIP, SIOP. This document does not live separate from those. So any commitments that we make have to be within those ranges. Now, we can specifically.
No, but
Yeah.
even within, like, say, within equities, right? I mean, you could wind up moving 10% away from current managers to new managers. I mean, that's a pretty material shift in aggregate. It hadn't changed the asset allocation, right? But you can make 5 to 2% moves, move 10% of the portfolio. You can move $3 billion in between meetings, right?
You want to,
So I just think there needs to be an aggregate limitation as well, you know, in addition, so that a series of transactions is contemplated to a risk limitation.
do you have any thoughts on
I would probably make it like twice, right? I mean, like 2 times whatever the individual limitation is. I mean, you know, if you're gonna be making more than, you know, 2 or 3, right?
And are you putting it within like a time period?
Yeah, because basically what this says, they're gonna report to us by the next meeting, and, you know, if we have quarterly scheduled meetings, so
would just say,
that's, you know, that's just kind of a quarterly
Yeah, you want to say
stop
within a quarter?
within a quarter, right?
All right,
Yeah.
that's fine. I mean,
What are you aggregating, the individual person making the decision or the asset category?
well, I think it would be do you want to say would you want it to be per asset class or total exercise in general, like public, do you want to put like say a 6% cap on public markets, or you can't basically use more than twice the authorization for any one asset class within a quarter?
I would, that's a fair question. I mean, I'm kind of thinking nothing more than 5% of the total portfolio in aggregate, right?
You want to just put that,
However you use it.
why don't we
You
just,
know, I
you
mean,
wanna put
that gives you room to do 5 private equity guys you could do, because those are gonna be smaller anyway.
Well, you want to just leave that, why don't we just put that in the first, so why don't we put the 5% limitation in the first sentence? Just say,
Right.
and then that way that within a quarter, but that the amount, the amount of delegation cannot exceed 5% within a,
Calendar quarter?
you want to say within a calendar quarter?
Yeah.
Or
Yeah,
between meetings. Yeah, how about we
exactly.
say,
It's
how about we
really
say?
between meetings,
how about
because if
we
we meet more frequently, it's
Yeah,
not a
between
problem.
regularly scheduled commission
Right,
meetings. So,
right.
yeah, how about that?
Yeah.
And then that way we can't, go crazy.
Right.
Can I, just as a preference?
Yeah.
Say that I would like that to be very specifically understood as new investments,
Correct.
not
Rebalance.
managing and rebalancing and, the overall portfolio exposure management exercise we undertake often at the end of a
Quarter.
of a fiscal year,
Yeah.
frankly, as we move from one allocation to a new allocation. I don't want this language to kind of interfere with the regular portfolio management activity. This would relate to the procurement of new.
Yeah, and we would limit this to investments made pursuant to this policy.
Sure, okay.
Right,
And I
right,
just want to make sure that,
right.
that concept
I mean,
is
you could
understood.
say it pursuant, this is restriction on new contracts versus existing
New investments,
contractual.
the aggregate amount of new investments made pursuant to this policy shall not exceed 5% of the value of planned assets in any one given quarter.
Right.
Or in between meetings.
Right.
However, and we'll make that sound better, but.
Correct.
And you want it at the beginning of section 3?
I think it's logical to put it in section 3,
That sounds good.
right?
And I think that's a reasonable governor on the ability.
And I wanted to make sure that Alan had time to discuss his issues, because I know he has to leave. But I have concerns.
I'm calling back in. I'm just going 15 minutes to get to the car.
I have
During the parking day.
concerns about the delegation for private markets versus publicly traded. Publicly traded, if the commission disagrees when it's brought to the commission, it's much easier to change a decision, whereas in private markets, once that capital is committed, it's much more difficult to exit that investment. So I have greater concern about delegation of authority with private markets, as well as Alan mentioned, the ability to use multiple private markets delegation, and the inability for the commission to exit those investments in an easy manner.
Yes, and I certainly, and this is not, this is something that Peggy and I have discussed, and, we both agreed to respectfully, disagree in this regard, and I think but I certainly understand and respect her concern. And my response would be that, the statute does authorize you guys to give us the ability to commit up to 1% for private market investments. We're coming below that, and I think that that's reasonable to come below that, because I think, 1% is a significant, piece of the portfolio. And again, it is not lost on us, nor is it that that 75% or 75 basis points of the portfolio is greater than $200 million. And the reason that we would, the utility in being able to do this is, at the end of the day, is to try to get cost savings, especially in the private markets, and the ability to move with speed, which would give us, be able to move with speed so we can get cost savings and potentially get allocations to funds that because of where and how they're going to close, we wouldn't necessarily ordinarily have the ability to get to. And so the ability to giving us the delegation gives us the ability to commit with speed. And you also want to be able to, I don't think you necessarily want to limit yourself too much in regards to the amount that you can commit, because the amount that you can commit to managers that you have a degree of confidence in, that have been subject to our quantitative analysis, you want to commit to them in size so that you can also enjoy or hopefully take advantage of those types of fee savings as well. We respectfully think that the amount that we've set is reasonable. Not that it matters, but we don't necessarily think that we would be able to get into any private market fund at any one given time in a amount of, given how oversubscribed that they are, in any amount close to $200 million. But we certainly are understanding of what that means in regards to actual dollars.
Are there any other comments, or this may be a good time for Makita to sort of present their report on, I guess, benchmarking against other states? Yes.
While we're on editing and additions, I have one change I'd like to propose, and this would be an addition to the items in Part 2, where that are essentially exceptions to the delegation policy. I propose that we add 2D, and here's the version I've written down, that the investment, other than in publicly traded assets, has important direct connections to South Carolina citizens, policymakers, or business firms. My thinking here, and I've heard from stakeholders about this, my thinking here is that sometimes pressure can be brought to bear on staff, on commissioners, and I'm thinking of this addition in connection with that. I understand that we have fiduciary obligations, we all do, and that we can't participate in conflicts of interest. But it's possible that pressure can be brought to bear, and that it could be brought to bear on our top 2 leaders. I trust our current top 2 leaders, but this is a policy that's for the long term. So this is sort of the trust but verify idea. So I throw that out. It may not be written in the best form.
Where are you saying to put it?
As number D in section 2, as sort of an exception to the delegation authority.
Some situation that would cause
Right.
the approval path to go back through the commission. Correct.
Yes.
Yep.
So for something with strong South Carolina connections, other than publicly traded goods, which we all own some of, would have to be brought to the commission.
Dr. Wilder, in regards to the way that it's worded, would you, if it said instead, and I think this captures the essence of what you're trying to get to, and we certainly appreciate any umbrella that you can provide us from from having to because the people will understand quickly that this has been if you approve this, that this is out there. So how about, would it be if the investment strategy, we wouldn't be able to do it if the investment strategy targets South Carolina, or if the assets of the assets of the investment would be principally, the majority of the assets of the investment would be principally located in South Carolina. And-
Or
Yeah.
managed by
An entity.
someone. Yeah.
Well, I wouldn't necessarily want to say managed by an entity because, I mean, we have, you know, Gray Stars here and, you know, they're not that would be my only respectful pushback on the entity itself is because they're here, you know, and I wouldn't want to, but we could, I'm not necessarily opposed to that, so.
You know better the calculus for these types of things than I do, but I think it's not it's not a challenge really for us to bring a Gray Star quality manager here. If that's the
Well, then you want to say,
if that's the
Ron's-
cost of the
yeah.
vaccine.
I think Ron's,
Yeah.
the way he has written it, it's a little more overriding. It might be someone with a connection to a firm that may not necessarily be an investment in South Carolina or domiciled here, but there could be.
Also,
It's not barring the investment, it's just saying.
Is,
Very general.
right, exactly.
Yeah.
I don't think barring this is a defect.
No,
Okay.
I mean, I endorse the concept.
yeah.
Sure.
And it relates to Peggy's point about private equity, since it wouldn't apply to the broad publicly traded assets.
That's what.
It would apply to individual, private, or other specific categories other than publicly traded.
Okay.
Yeah, we've got some statutory guidance there, and I think if it has the implications you talked about, I think it's incumbent on the commission to make that decision.
Right.
Okay. Would you, I think we have, in essence,
2 amendments
at
already,
least 2
right?
amendments, and I didn't know if Ms.
If-
Boykin had if there was a, you know, a specific, if there was a, in regards to your concerns about the private markets, if there's a specific, if you wanted to propose a specific change in regards to the.
The Third Amendment to.
Yeah, yeah, like how much,
Yeah.
that you would be.
Well, since I don't get to vote.
Yeah.
But, to me.
You do get to make motions.
Yeah. I can make
You know,
motions.
to me, I think when you look at private markets, $100 million seems a generous cap for that. When you look at the private markets, and I understand that you're trying to look at a percentage so that it changes with regard to and relative to our portfolio as a whole. But I want to make sure that I understand the spirit of this delegation. So if this delegation were to be adopted today, then you would expect that any private market investment that does not exceed the cap or meet one of these exceptions would be handled just through staff and through the normal process. I mean, I do appreciate that you're continuing with the due diligence process that we have in place, which I think staff has done a great job of setting up that investment process. But you would expect staff to implement all of those investment decisions that fall below that $225 million cap today, and only bring them to the commission at their next meeting after the fact, rather than only taking action on those items that are more time sensitive within the period. I just want to make sure that I understand what the intent is and how the policy would be implemented.
Well, and unless it fell within one of the other caveats that are in section 2, whether we haven't, the strategy is not something, it's not an investment strategy that has been subject to our due diligence process previously, where it's been approved by the commission. So if it's really, or the assets are invested in something that's not,
Rebecca, this is Alan, I'm back on.
Okay, thanks, Alan.
So if if it's a new type of strategy, then it would still come to the commission. So it's really, these would be more the well-trodden ground versus, and that's why we wanted to make sure that we built in the protections in section 2. But I mean, given the environment now, yes, I think the majority of the public, or the majority of the private markets investments would fall below that threshold because those are the allocations that you would be able to get. you know, I would say, you know, whether you express it as a percentage or as a hard dollar amount, I would just say that, you know, 100 million I think is too low, because that's all, I mean, that's all you're gonna get in essence. And, you know, I think we want to have more the flexibility to go up. You know, I'm not as, you know, and I think Makita's recommendation was, correct me if I'm wrong, but was anywhere between 50 basis points and 75 basis points. So, and I'm also reticent to put a hard dollar amount in there, again, not because we're trying to hide anything, but because I want, as the value of the portfolio is much more likely to have a drastic downturn than it is to have a drastic upturn. So the ability of and I would want whether it's whatever the amount is, I would want that to compress as the value of the portfolio goes down. I think that's a best practice.
Right.
So that you can't overcommit versus the value of the portfolio, and I think that's a much better practice. But you know, leave it certainly within y'all's purview as to whether or not you think 75 basis points is too high or whatever.
Or we can just hold that in our heads and think about it as you guys sort of go through your report.
We can show you other large systems and the actual percentage that they have adopted in terms of the maximum. So it might help.
And I did look at your report in advance and appreciate the work that you've done there. I think that the statement that Mike made at the very beginning of the presentation, I think, is, you know, can't be overemphasized, and that is that this is a dramatic shift in philosophy. It is more than just delegation to staff. And please know, as I said earlier, I have a great deal of confidence in Mike and Jeff and our staff. So this is not intended in any way to imply that I don't have confidence in our staff. But it is a significant shift away from, you know, not only having a process of due diligence and internal vetting, as well as our investment consultants vetting the investments before they come to the commission, but it is virtually shifting and delegating almost full investment authority to the staff, while the commission would still set the asset allocation in those ranges. Most of our investments are not going to exceed that in private markets, $225 million, and public markets relative as well. So we are, in essence, delegating full investment authority to staff. And as long as the commission is in agreement with that, then, you know, as Mike said, I think that is a dramatic shift. And I just want to make sure that everybody understands that. It is more than just delegating when there is a time-sensitive matter at hand.
Just to make sure that so that there's a ramp up, to make sure that you're comfortable with how it works, and if you feel like, because you made that statutory.
Mr. Hitchcock just had a brilliant idea, but and he suggested maybe we craft something like a phase-in period for the first year, where we limit the use of the policy to a certain number, like one asset per category, per asset class, one investment manager per asset class, and sort of as a trial run to see how it goes. Because as Peggy points out, it is a dramatic shift. And I'm sorry.
Oh,
go
no,
ahead.
I didn't mean to interrupt you. I'm sorry.
No.
You're the chair.
No. I was going to
And
say.
what I was contemplating is that, you know, for the private markets, we'll still have the, you know, if the commission is comfortable with it, still have the overall 5% limitation in regards to the, you know, to the aggregate that'll live in the policy forever. So that would be at the beginning of section 3. But then on the private markets, we would say for the first, you know, whether you want to call it 6 months or a year of implementation, that we would only use the authority for one investment per asset class in between meetings. so that,
Or
you know.
up to. I
Yeah,
should
up to,
say,
yeah,
yes.
up
Right.
to, yeah, that we won't exceed more than one investment per asset class. And then that gives you time so that there's, you know, and we're not, I mean, right now, we're averaging one private equity commitment about once every year and a half. So, you know, we're not exactly, you know, and I don't see that appreciably ramping up as a result of delegation. So that'll give you a phase-in period.
Mike,
Yeah.
this Alan. I mean, I'm sitting there thinking, and I hadn't really thought about it until Peggy brought it up. But I mean, I'm not technically. I don't like the idea of phase-ins on policies. I mean, I'm kind of more in the camp you either develop one or you don't, and if you don't like it later, you know change it. I'd be more inclined to just split the policies into two separate ones, a public, you know, policy delegation and a private, and then allow the commission to maybe socialize the private market one a little bit more. I mean, that, you know, while we just kind of think about it, because I don't think we necessarily have to. I mean, as you stated earlier, this is a big change. As Peggy stated earlier, it's a big change. I don't think it kills us to socialize it for another meeting, right? Because, I mean, I think McKee's information is good. I think it's the right direction. I just think it is a big shift, so maybe we just want to split the policies into two separate and distinct ones, one for public markets, one for private markets, and then socialize it more.
I mean, we could just say that the public markets goes in, that you could say the public markets goes into effect. And then you could have the private markets one, we could just, and just say that doesn't go into effect yet.
We could say that.
Yeah,
Yes.
because they're bifurcated, Alan, they're bifurcated in the policy. So, you know, I think you could just say that, you could say section, you know, that the policy limits in the motion, you could say the limits for section 3A take effect immediately, and then that the commission will come back and consider
The policy limits for the private market section of the policy.
right, yeah, and then the private markets, that will hold the private markets part in abeyance until the following meeting.
Is that a valid legal construct that Betsy is? Okay. Would we like to hear from Makita now? I think we've covered everything.
We
No,
could do
but
the
I-
abridged version.
Yes, an abridged version. I genuinely would enjoy hearing your perspective and get a little flavor for, I guess, what our colleagues are doing around the country.
Certainly. So we did. Yeah, yeah. I can
Did the
preview it. Yes. So when we set out and did our research on other large public state retirement systems, we sought to answer 4 questions, really. You know, who is delegating? What parameters do they put in place? What reporting is required to the boards? And lastly, to what extent, if any, has the decision to delegate or not had on performance of the retirement system? So we have 29 pages here. We'll cover maybe 7 pages. And we've got the summary and recommendations right up front. So surveyed 45 large state systems, focusing on those with over $10 billion in assets, and nearly half have delegated investment authority to their CIO or to their staff. The trend in the industry appears to be moving more towards delegation. Feedback is that boards are trying to focus more time on asset allocation and other strategic decisions and less time on the operational aspect of hearing the presentations and approving a manager. The findings were kind of, as you'd expect, dependent on the size of the retirement system and the size of staff. So larger systems were more likely to grant their CIO discretion, and that was we would assume primarily a function of the larger staff that usually accompanied a larger system. So if you kind of separate our sample size into those systems larger than the South Carolina retirement system and those smaller, you can see the larger plans, more than half, 56%, have gone and made this step and delegated the selection of investments that granted that authority to their investment staff. If you look at those plans that were smaller than this system, it's less than a quarter that have done so. So the bigger peers of yours are moving this way in larger numbers. So our recommendations, based on our review of what peer plans are doing, we feel it would be consistent with your peers to take the step of granting the CIO and staff the discretion to execute investment decisions. We kind of already got into the public managers versus private managers, but most plans treat them differently. For private market investments, nearly every plan that has granted delegation puts an explicit limit on what size commitment the system can make, and either in dollars or as a percentage of plan assets. On the public markets managers, those with liquidity that you could hire and fire, with ease, pretty much no one puts an explicit limit in their publicly available policy documents. A few did, but most simply went unstated, with the assumption that the decisions would have to be consistent with the asset allocation targets, but they didn't place explicit 2% in a public markets manager. Somewhat of a moot point here with the way the statute was written, but an interesting observation from our findings.
What's the range of percentage limits?
Percentages for the private markets?
Yeah.
It's as low as 0.1% to as high as 1%.
The average and the medians seem to fall in the 50 basis points to 75 basis points range, which is what we have suggested for this system, that the commission adopt a maximum allowable commitment size of either 50 to 75 basis points or somewhere in there for your private equity, private debt, private real estate, and private infrastructure investments. We listed venture capital as slightly lower. I know you don't have an explicit target in your SIOP for venture. It typically falls under private equity, but the only reason, a few had a smaller maximum for this, and we kind of agree just because in general venture capital investments have the widest dispersion of potential outcomes. So some could be really fantastic, but others could be a bust, and that's the nature of that asset class. And then the final recommendation pertains to co-investments. What we've seen from other retirement systems is that if a co-investment was made alongside a limited partnership fund, so if Francisco Partners came to this system and said, would you like to make a co-investment in one of the companies, that usually that kind of tack-on commitment is included in the total maximum. I'll pause for any questions before going into some of the data. Okay, so this slide and the next slide we list out which state systems have delegated, their size, their staff, and the 5 and 10-year trailing performance. And then the following slide, these are the plans that have retained the investment authority with the board. So the observations to make, if you go back to, so this is the slide where they have delegated authority to CIO and staff. If you look at the bottom and you look at the average size and average investment staff size, up in there, around 80 billion and 80 staff, lower on the median, but compare those to this group of plans, just kind of validates again the observation that the larger plans have led this change into delegation. What's interesting and somewhat expected, if you look at the performance numbers for one group versus the other, they're pretty much identical. So this is the group that board has retained discretion, and just look at the average 5 and 10. You see 6.7 and 5.8. This group 6.7 and 5.6. So
and there's a bit of noise in that because this just shows who had discretion as of this date. That doesn't mean they've had discretion for the last 5 or 10 years.
yeah, and every academic book will teach that the majority of your performance is led by asset allocation decision, and that is retained with the board in both groups. So it's not surprising to see these numbers kind of similar from the performance standpoint. So just some of the observations. The language was, we looked at publicly available documents for these systems. So their investment policy statements, their annual financial reports, websites, other governing documents. In most cases, this language was a component of the SIOP or investment policy statement. So we agree with how or where you intend to place this language. Some of the systems had very extensive policies and parameters, and we've listed many of those in the appendix, and others were very short and high level, just simply granting discretion and on the assumption that maybe the details were in an internal procedure document. From a reporting standpoint, there was nothing incredibly insightful. In most cases was that all decisions and actions would need to be reported to the commission at the following investment meeting. So you guys are in line with peers the way you have identified the reporting requirements. I think this next slide will kind of lead us to the end here, but this is the subset of plans that explicitly put a maximum commitment size on their private market investments. So it goes from largest to smallest, and then the far right 2 columns. So you can see it broken out as a percentage of plan assets and in dollars. The numbers that are bold are what is actually in the policy documents, and the italicized numbers are the implied math. So you can see some listed in dollars and others listed in a percentage of assets. We recommend how you guys have proposed the policy in percentage of assets. But kind of going to the bottom and looking at the average and the medians, and we think the subset below 100 billion is more applicable here. So, we proposed a range of capping it somewhere between 50 basis points and 75 basis points. So 50 basis points fits nicely in between the average and the median of the peer systems out there. And then 75 basis points on a $30 billion plan works out to be exactly $225 million. So that is the median maximum that peer state plans have adopted under peer plans that have less than $100 billion. So I think the overarching theme is that plans are increasingly moving towards this decision. They all retain the asset allocation control at the commission board level, but more are moving towards putting in place a policy where they want to spend less time hearing manager recommendations and more time thinking about long-term objectives so that they have delegated the decision-making authority to their CIO and their staff.
Questions?
Are you aware of systems that have adopted delegation policies and then reversed that decision later after experience?
We're not aware of any, but it's not to say that hasn't happened.
Along those lines, the policies we're creating right now are, I believe they're residing in the SIOP, which is something that we revisit every year and have to reapprove.
Yes.
So from that standpoint, it's the type of thing that every single year we're going to look at it and we could adjust limits on it or remove,
Revoke it.
literally revoke it like Dr. Wilder was just referring to. And it, I guess being in the SIOP is forced in front of our face every year. It's not something that we would forget about. So I'm just wondering, along with, just addressing Peggy's concern and looking at your limitations, you were suggesting ranges of 50 to 75. I'm wondering maybe, right now we're at the upper end of your range. What if we bump that down to the lower end of your range, 50 basis points, and went forward with that, again, knowing that the SIOP is going to be coming up before us. When does that come up again?
In the spring.
In the spring. So knowing that we're going to be forced to revisit this policy again in the spring, and it sort of is a trial period, but at the same time, we're putting it into effect. I don't know if that satisfies anything or
What is our asset allocation to private equity right now?
Well, it floats, but it's built off of an assumption of 9%.
Rebecca,
yes.
can I ask a legal question? And I'd like to get kind of the committee's thought. I mean, and also the investment staff, right? I mean, it's not something we normally do, but, because I was thinking about Peggy's concern, right? Given both, not only privates, but I was thinking even publics, right? I mean, you could have public, security subject to a bad contract, right? So we need some sort of contractual standards that we're going to adhere to in conjunction with the policy, right? It's kind of my initial, got me thinking down the path, but in contract law, and I'm curious to get legal feedback as well as investment committee feedback, what if we had the policy, but that any contract entered under the policy would be subject to rescission, right, until such time as the next meeting?
I mean, that's your,
Precision.
yeah, you're
You're not gonna get anything closed in private markets.
yeah, you're not gonna get anything close. I mean, practically,
You're not gonna
yeah.
get anything, so it won't be
Right.
treated as a final contract if it has to go through a final approval through the commission.
Well, but no, there's a difference, right? Because with rescission, right, you basically are saying we're accepting the contract, but if we, in essence, pull out at a later time, we're going to try and make everybody whole. And so it really just becomes like another effective close for the fund, right? Yeah, we would have to pay back probably penalties and interest and things like that, right, to a fund, but it wouldn't subject the fund to additional negotiation in relation to the contract.
I'm going to defer to.
Just based on our experience, I'll say just based on the experience we had when we had the 30-day review period in effect, it made negotiating contracts, first off, it made the time frame much longer, and it did impose a lot of uncertainty with managers of not knowing whether or not it was actually going to close. I think that would be a problem, particularly in today's market where so many of these are one and done closings for a lot of funds. And timing is a problem, and timing is of the essence to get them closed, that if they can't know that we're really going to commit, even if we say we're going to pay back penalties and fees, which raises other concerns, I think it would make it a very difficult investment landscape, but I would
Well, one of the things,
refer to the investment staff as well.
you know, one of the things, Alan, too, to think about, you know, in thinking about this is, you know, we're, you know, the managers that we deal with are very intelligent people, and they know, like, under the process that we have now, they know when, like, an investment's been approved, that you guys have approved the investment. So from a negotiating standpoint, it gives them a little bit more leverage. And, you know, the thing with being able to have kind of the ultimate club of being able to pull out at any given time, that it's not, that the investment is not closed until all of the contractual provisions that we need, and, you know, legal sufficiency is also a part of an attestation that the contract is legally sufficient is a part of our process anyway. You know, having the ability to, you know, to use that as leverage, that, you know, there is no, you know, we are the, you know, in essence, we are the final authority, and, you know, you're not going to get this done until you agree to the terms that we need you to agree to. It gives us more, you know, it gives us more ability to, I think, or gives us more leverage in negotiating those terms that become sticking points, and that, you know, those contracts take a lot of times 2 to 3 months after, you know, the way that it works now, take 2, 3, 4, 5, you know, even up to a year after you approve in order to get negotiated. Having the ability to do that at the same time, I think, gives us more leverage in those legal negotiations. And knowing that we're the, that Jeff's got to approve it, and, you know, that basically that we have to approve it in order for it to happen. And I think that, you know, that given that kind of uncertainty, I think it would be difficult to, you know, it would be difficult to get things. I mean, because, you know, the problem is if we close something, you know, we close something, like, for instance, at the beginning of like right after, like maybe a month after a meeting, then, you know, and there's 2 or 3 months until the next meeting, and we've already committed capital. You know, I mean, I think that there's a lot of, like, potentially capital's already been called. I think that we get into a lot of particular issues about that. And the other thing that I wanted to make sure that I meant to bring up, this isn't necessarily responsive to your concern, but that I wanted to bring up, that we were, as part of this process, that we were going to do as well as, you know, we have a pipeline that we, you know, a pipeline of potential investments that we have, you know, that we're working on at any one given time. We were going to make sure that we're providing you all transparency to those potential investments as well as the size, so that you would have as much it wouldn't just, whenever you're thinking about the use of this policy, it wouldn't just be a look back. It would be a look forward as well, where you would have the ability to access the pipeline at any one given time to know what we're thinking about doing, you know, so that's I think that is another protection that is.
Do we have that written into the proposed policy?
We don't, but we can. I mean, we certainly add that. So, I mean, that was something we were going to do as a matter of practice of implementation. So. Regardless of the policy, we're going to do that anyway, because we feel like it's a good idea for it not just be to look back, but also a look forward as to what you're, you know.
I'd just like to add, I have concern about whether or not if we went down a path with rescission, I think that we would really struggle to find ourselves getting allocations. We're frankly still in a period of trying to repair our reputation with the private markets community, and if it looks like we're sort of not transacting in a way that others do, I think then we are potentially disadvantaged, both with allocation and frankly with the risk they assign to us as an organization, and that would affect the outcome of negotiations potentially. So.
If a contract was subject to rescission by somebody else,
Randall,
it was not a contract yet.
Speak up so I can hear you.
Alan asked for you to speak up. So
I said every contract I've ever negotiated with anybody, if it's subject to revision, nobody considers it as a contract yet. And they don't treat it seriously. And they always figure you're trying to put something over on them too.
Are there any other, I mean, thoughts on, on looking at private equity at the very bottom of the range, down to the 50 basis points, and approving the rest of the policy with that, those in all of, yes, everything, every private market asset, yes.
It's gonna be
Yes,
for my clarity.
again, yeah. Knowing that, again, we'll be revisiting this in the spring and every spring hereafter, does that appeal to anybody?
It makes some sense to do it as a percentage of the allocation to the to private markets as opposed to just a
Overall,
fixed number of
yeah.
bips. Like if you did a 5% allocation, 5% of the private markets allocation, that'd work out to be 45 bips currently, but
Okay.
when we move it up, a 10% thing would be.
I mean, my one comment, and Mike, this goes to, a little bit, I hate to say it, the website, right? I mean, you mentioned the transparency into the pipeline. I mean, that is your check and control, right?
Yes. Yeah.
Ultimately, because presumably before these contracts are being entered, there's drafts of them, there's other due diligence documents that staff are seeing that are easy enough to post to the extent that a commissioner, wants to have that check, right? I mean, it doesn't have to all be post environment, but until we have the operating environment to support it, I think that's kind of the issue to a degree, right? I mean, that is the rub, right?
I mean, I think I think we have the operating environment. I'm not necessarily as concerned about it. I mean, I think we have the right. I think the procedures are right. The pipeline. How about this? Why don't we provide you with as part of when we give you the monthly performance, the monthly performance, we'll provide you with a pipeline on a monthly. And the pipeline has commitment size, it has some descriptors on there where where you would be able to tell what we're doing. You know what I'm saying, or what's in the pipeline.
Right.
Does that make sense? So
yeah, well, and that's where, I mean, I don't think it's unreasonable, right? I mean, presumably y'all get to some sort of version of a final contract before it's signed, right? I mean, I don't think it's an unreasonable request for that to be posted, because we get an email when something's posted, right?
Right.
Prior to being entered, right? I mean, that allows you at least the Hail Mary last second call,
Yeah, like if yeah, that's fine. I mean, we can we can, as we post. I mean, as far as as we post documents, we can make sure that those are available to you all. So yeah, I mean, as we like. So.
And I'm not necessarily saying draft versions, right? We don't need that, but before our final contract is signed, it should be posted, I think, in advance, ideally, right?
Yeah, that's fine.
Not that you can't enter it, but I think just having it up there, right, at least provides a check before something completely sails,
Yeah.
Yeah.
Yeah, that's fine. Yeah, why don't we just say that we'll do that? Why don't we put in there that we'll I mean, we've got for contracts now. We have the 70. We have the 3-day review period. Why don't we say no later than 72 hours prior to executing an agreement? We'll post the contract for and watch. So for y'all's review.
Yeah.
And then if you think we've gone off the rails, y'all can call a meeting and put us back on the.
Right.
Y'all can call a meeting and put us back on the train. Put the train back on the tracks. So,
right.
Yeah.
And you would include the due diligence and investment consultant reports
Yeah,
in
I
that
mean,
as
we
well?
would try to get as part of the, we would give you basically just access to everything that we have. So, which would be it's all all the documents that are in there. We would give you the ability to look at those. So. Does that make sense?
So in section 5, instead of saying within 3 days.
Right.
Okay.
Yeah, within three, we would say.
Within 3
that-
days before.
Within 3 days before we
Yeah.
executed the agreement.
Okay.
Correct, yes. Yeah.
And these would all be private to retain your tactical advantage of.
Yes, yeah, I mean, there would be
Not
the
being
same,
in a
yeah,
public
like
meeting.
non-disclosure, you know, because we don't want to, obviously, we didn't, you know, this would be a look, same, you know, level of confidentiality that we apply to everything that we do now, that you get before anyway, so. All right.
So with that, are we still comfortable with 75 basis points, or do we still want to do the 50 basis points?
I'm comfortable at 75 personally.
Thoughts? I think he's talking about private right now, or just private right now.
Yeah.
I would obviously prefer a lower limit on private.
Yeah, with that extra control in there, 75.
Okay, with the extra controls, Ed, do you have thought, you're fine with 75? Ron, do you have thoughts? With the,
Yeah, I don't have any objection to 75.
okay, with these extra controls. So it sounds like, I'm sorry, do you want to go ahead and say
Yeah,
something?
and what I was going to suggest, Madam Chair, is how about we do this? That we would, I believe that the amendments that we would have on the table would be the 5% aggregate amount that would appear in section 3. At the beginning of section 3, we have Dr. Wilder's language in regards to investments that have substantial connection to South Carolina.
Right.
And then we would have the requirement that the documents that we have, I think, listed to make sure that we provide to you all.
Due diligence and final contracts.
Yeah, that we would do that, that we would post those 72 hours prior to executing. That would
Yep.
make sure that you had access no later than 72 hours prior to executing the contract. My suggestion would be that you approve that in concept, but that we will provide you all with a revised, like a policy taking all that into consideration, and then if there are any significant, well, basically that you be delegated, like you would with an investment contract, that you be able to, you be delegated the authority to approve the final, the final version
Yes.
of the policy, would be my suggestion. In consultation with the other
Can we
commissioners.
use that as, as the motion, or do we need to read the motion subject to those amendments? Betsy, what do you think?
Well, I do think we need to read at least part of it regarding the acceptance of the report
Okay.
by Makita pursuant to
Okay.
the statute.
So you, do you want me to read through all A, B, C, D, and E, and then discuss subject to the amendments listed by Mr. Hitchcock? Would that be, okay. I
And
guess.
the language regarding the technical amendments to the policy after, to conform to the amendments made during the
Okay.
meeting.
All right, so the motion on the table is, to adopt the recommendation of the CIO and the Internal Investment Committee as set, and it's actually the next one, thank you. To approve and accept the report on delegation by Makita Investment Group as sufficient for purposes of compliance with SC Code annotated section 916-330E. B, to adopt the delegation policy as presented, add the delegation policy to the Statement of Investment Objectives and Policies, the SIOP, as amended and adopted on June 22nd, 2017, and reaffirm the SIOP as amended. C, to approve the delegation of the final authority to invest to the CIO, subject to compliance with requirements SC Code annotated section 916-330, and within the parameters established in the SIOP as amended. And D, approve the effective date for the
Let's say that would be, that we will accept the amendments, accept the amendments that have been discussed, and that the policy would go into effect upon your approval.
Okay.
That the policy as presented reflects those amendments.
Okay.
Does that make sense?
That does. Would someone like to make that motion? We have a second motion and a second. All in favor? Aye.
Any opposed?
Alan, do you approve or not?
Alan?
Hey, can y'all hear me?
Yes.
Yes.
All right, sorry, I think I was on mute and eating a sandwich at the same time, sorry.
That's good.
I'm a yes.
Okay.
Very good.
Excellent. The ayes have it.
All right, very good. And, Madam Chair, I believe that the food is
Ah,
here.
okay, so we have some
so
lunch.
Maybe we could break for a minute to get lunch, and then if we want to, if Makita doesn't mind to
Have a lunchtime
have a
presentation.
lunchtime presentation.
He
we-
will ask fewer questions when your mouth is full.
Yeah, we'll,
That's
we'll,
fine.
we'll be sure to provide you, yeah, all the, all the attention necessary, but maybe just a,
Okay, perfect, yes.
right?
I'd like to go ahead. Please do.
Thank you. Good afternoon, everyone. First, I want to thank the chair for the wonderful welcome this morning. We look forward to this relationship, having the opportunity to work with you, the board members, the staff. So far, the staff has been great to work with. To echo David's comments from earlier, through the whole RFP process originally, and then everything since then. Particularly recognize Dory, who's been kind of our liaison with staff and has done a lot of work as well. What we wanted to go through with you today is what we call our initial fund review. And this is something we do with every single client when we are hired. One of the main reasons we do is for our own benefit. This is our chance to really get to know and to understand your portfolio. But of course, we're also doing it for your benefit. We want to share our findings with you. And the way we lay it out, go forward a few slides, is we cover every major topic that we think is important to a plan, dealing with governance, dealing with asset allocation, portfolio construction, and even some of the operational aspects. And we make observations about each one of these items. And then we make what we call a priority in terms of how soon should we address this. Because even though this is intended to be in some ways comprehensive, it's very broad, but we don't really have a chance to get deep into each topic. So a lot of what you'll see is us saying, let's take a deeper look at this issue. And we prioritize according to what we think should be the most important priority. Now, we want this part to be a dialogue. We might think that a certain thing could be a lower priority. You might think it's a higher priority, and we can adjust our expectations accordingly. The other thing I want to note, and this is right off the bat, we do this also just to see, is there anything that's just stands out as a red flag? Right on day one, oh no, you need to change this. And the answer here is, if I'm sitting in your shoes as board members, no. There's nothing that says to me, you should be worried about this, and we need to take care of this right now. We're at a very high level, we're very comfortable with the plan and the way it's invested. So in some ways, I could stop there, and you'd probably be happy with it. But I do want to go ahead and move through the rest of the document. My plan is not to cover every single issue. Obviously, you've seen the document in advance. Focus mostly on what we've considered the priority 1 and 2 items as we go through the document. So I may skip some pages as we go. So I'm going to skip past philosophy and go straight into governance. And the first thing with governance deals with investment policy. You'll see the way we have laid out for every item, we explain what the item is, what an investment policy statement is. Obviously, you're familiar with your own. What we consider your status to be, you have an investment policy statement, the SIOP. What our recommendation would be, and then the priority. So in this case, yes, you have an SIOP, as has already been discussed several times today. It gets updated or at least reviewed on an annual basis. And what we've laid out on the next page in this case are a number of things that we point out are very consistent with best practices in the industry. And then on the right side of the table, a couple of things that we might want to address the next time the SIOP is reviewed. These aren't things that necessarily have to be included, but things you could consider includes maybe things that have been discussed in the past. We don't know. But they include roles and responsibilities. For example, should you define what the consultant's role, what investment staff's role is? Should you be adding constraints around what factors should be included, whether you make specific reference to statutory requirements? I know there are a couple CFA charter holders in the room. They tell you should be looking at liquidity and time horizon and explicitly expressing those constraints in your policy statement. Some things might be like housekeeping, something like the assumed rate of return. You might move to an appendix because that might get updated on a more regular basis. You can reduce manager guidelines and maybe move those to separate documents. And then one other housekeeping item was the real estate benchmark. Real estate's private market. They tend to be reported on a 1-quarter lag. So that might be something we address the next time through. As Jeff mentioned earlier, benchmarking is something that might get addressed as part of that process. So as the GAA or GTAA component is updated, we'll address the benchmark in there as well. So because this is something that's already regularly scheduled for the spring, we'd say stick to that schedule, and these are things we'll make sure to address when we come around to that.
Can I ask one thing? You point out something that every year we've sort of tried to figure out what to do with all that guidelines that you point out. We include in this document, but you'd love to see essentially evaporate. Do you see other people do it the way we do it, or are we an outlier in that regard?
It tends to be when you have a bigger plan like this, and you sometimes end up getting like sub-policy documents too, that the guidelines tend to be separate from the investment policy statement, and the policy statement would simply say, see individual manager guidelines for each asset class.
Thank you.
Which is page 12. That's something that we can address in the future. That's a priority 3. So I'll actually jump ahead to page 13. Just a note, you have other internal policies, most of which have been updated or adopted very recently. You see 2016, 2017 for all of those. They're all very comprehensive. We have a couple of thoughts, some that deal with the investment plan, but again, these are low priority things, so nothing that we need to dwell upon at this point in time, but things we can address as we go through the policy statements. I'm going to jump ahead to page 15. Asset allocation, it's not just our philosophy, but Aaron mentioned it earlier, is going to be the driver of your returns in the long term. When you compare yourselves to your peers, how you do versus your assumed rate of return, the asset allocation is going to be the largest single determinant of how you do. And hence we think it's something you should spend a considerable amount of your time on. It's currently scheduled for the December meeting to sit down and talk about that. When we went through your current asset allocation, it has a projected annualized return of 7.5%, and if you flip to page 6, you're already there. Thank you, Aaron. You can see the way the targets are set up, and we're showing the fiscal year 18-19. I think it was Steve. Steve alluded to the glide path earlier. Maybe it was David. That you're moving towards certain targets. Based on your current targets, we think you're at a 7.5% expected return, which gives you a little better than a 50% chance of hitting your 7.25% target. So we're going to spend a lot of time in December. I think it's going to be the whole focus of our portion of the meeting in December on asset allocation. One thing you should start thinking about in advance of that is how much comfort, how much margin do you want over that 7.25% return? Are you comfortable with being at a 51% chance of hitting that target return over a 20-year time frame? Or do you want a higher percentage, higher probability of getting that. I will give you a sneak preview. My answer to that is if you do, there are no shortcuts. Your plan is already very well diversified. So for you to get a higher target return, it's going to require taking on more risk. And so that's a debate. We can't tell you to take on more or less risk. We can tell you that if you want a higher target return, that's what you will have to do. And when we go through the asset allocation in December, we'll spend a lot of time looking at different risk metrics, helping you get an understanding for that, so you can decide, yes, we're comfortable where we are, or no, we do want to take on more risk, or we're comfortable taking on more risk in the expectation of getting a higher return.
Does that 7.5% number currently reflect the use of a portfolio or a portable alpha strategy for a portion of the portfolio, or is that?
It does.
Okay.
The one thing it does not assume is any alpha. Right?
Sure.
When we do our projections, we don't assume that your hedge funds are going to give you alpha, that your private equity is going to give you returns above the average private equity return. Certainly that is your hope. That's why you have staff, that you're going to get better than that. But we're somewhat conservative in our assumptions in that regard. So again, we'll spend a considerable amount of time on that in December, and you'll get a sneak preview of some of our thoughts as we go through the rest of the document. Pages 18 and 19, we start getting down a little bit further and talk about manager structure. Now, a fund of your size is in an interesting position. $30 billion gives you a fair amount of negotiating power with investment managers. And so you can take advantage of economies of scale in many ways. The more money theoretically you have, you can negotiate better fees. But there may also be a concern of, well, I don't want to put all of our U.S. equity money into a single active manager, right? That represents risk of a different sort. It represents that manager risk. What if there's a key man event? A person leaves, starts their own firm, hits by a bus, whatever the scenario is. So that's often why you see, and in this case you do see on page 19, for almost every single asset class, you have multiple managers in that asset class. And one thing we look at is how much overlap is there among those managers. I think both Jeff and Mike alluded to earlier, similar philosophy that we have. We don't want to, we don't think you should pay for alpha when all you're getting is beta. So I'm using industry jargon here to say, if you're just getting the returns of the market, you shouldn't be paying for active management. So if you have, we've seen structures where you might have 5 active managers whose bets are essentially canceling each other out, who when you add them all together, they look like the index, but you're paying active management fees. We don't think that's a good structure. What you have instead is something that's, I think, a bit more complementary. You have, for example, in global equity, kind of what we call a core satellite approach. You have 2 index strategies and then 3 what we'll call enhanced index for now. And that's in the global equity bucket. So there's naturally going to be some overlap. Clearly, when you have passive exposure, you're getting exposure to the whole market. There's going to be some overlap there, but it could be in a very efficient way. And that's something where we do want to dig in more as time goes on, and you'll see that. So for each asset class, we listed how much overlap we saw among the managers. And it tended to be small or no overlap at all. In some cases, there is a bit more overlap in those asset classes where we'd say, oh, let's, we want to have maybe more conversations with Jeff to get a better understanding of what he's trying to achieve in those asset classes. Because sometimes it could just be style differences. One's a value manager, one's a growth manager. Or, one's a quality manager, one's a momentum manager. And those styles may be very complementary to each other. Even if there are some holdings underneath that are the same, it can be a small portion and a small driver of the overall returns. So in general, our recommendation is to be to look at opportunities where it does make sense to be specialists, to go down that road. If there are opportunities to simplify the roster, because this is the other thing that we're just talked about, giving more discretion to staff. Part of that is just recognizing that you as the board members have limited time and resources, that in some ways, for your sake, a simpler roster is better, but simpler is not always better. So trying to figure out the balance as we go forward there. Along a similar theme, the next couple pages talk about active versus passive management. And we're kind of updating this theme as we go through time. It used to be just black and white. It was one or the other. Either you had managers who were completely active, or the strategy that was just the Vanguard index fund completely replicating the benchmark. We tend to be skeptical in general, but also of active managers. Part of that is just a cynical nature we have as a firm, but part of it is just based on the data. There are a number of independent studies and studies we've done ourselves, and here are some of the numbers on page 20 from our own study, looking at how active managers have done. And what this table is showing you is a couple of things. So what we did was went through publicly available information. We stripped out all the survivor bias, which is managers, only the good managers are still in the database, and also stripped out anything that shouldn't really have been classified where it was. So you can't really compare, a manager who focuses only on the technology sector shouldn't just be compared to a broad U.S. equity benchmark. It's not an apples-to-apples comparison. So once we scrubbed the data pretty thoroughly, we said, okay, looking at that, how did the managers outperform relative to the benchmark? And this was the excess return. And what you can see is it varies by asset class. That's not surprising. And the other thing we're showing is the 25th and 75th percentile. The difference between those is what's known as the interquartile spread. Why do you care about that? Well, that's a pretty good indicator of, in some ways, how efficient an asset class is, and an even better indicator of how much value you can add by picking a good manager. So if you pick a really good core bond manager, you can maybe add, in this case we're showing 94 basis points over the benchmark. Whereas if you pick a really good small cap stock manager, you can add 600 basis points over the benchmark. So clearly that looks like a less efficient place. Maybe it makes more sense to be active in an asset class like that. What we're not showing on this page are private markets, and partly because you don't have the choice of being passive in most private markets, but if you look at private equity, the interquartile spread is literally 20%. So it's a huge gap between the good and bad managers. So very much the case where you have to pick the good managers. The flip side of that is if you pick the bad managers, you really suffer behind it. So this influences our philosophy of which asset classes you should be active in and which ones you should be passive. Again, if you have limited time and resources, focus your active dollars on the areas where you can get the most bang for your buck. Areas like emerging markets, non-U.S., small cap U.S., and that's what you see the data on this page. So on page 21, what we're showing is how much passive exposure you have in each asset class. And you have a pretty interesting structure because in addition to traditional index funds, you're getting a lot of your passive exposure through the overlay program. And that's not necessarily good or bad. So long as most of what we're trying to do get with passive exposure is to replicate the market at as low a cost as possible. And you're getting a very low cost exposure through the overlay program to public markets. So it is a very efficient program. In total, and this was as of June 30th, and some of that may have changed since then. For example, Jeff mentioned the commodities exposure was eliminated. I think we said neutralized in the footnote. But roughly $7.5 billion, which is to say a quarter of total plan assets were passively managed or had passive exposure to the markets. That varies by, it's one of the other things we've seen as we've looked at different managers. You can see if you look in the next page, 22, we have a couple of pie charts, how much of your public equity, it's 60-40 essentially in public equity. And in fixed income, even a bit more in active management. Now, to be fair, when we're saying public fixed income, that includes your credit. And credit tends to be a much less efficient asset class. So there, you're almost always going to have to go active. But on, when talking about treasuries, you have some overlay exposure to treasury futures, very efficient way to get that. So again, these are areas where as we go forward, we'll say, okay, what's the best mix of active and passive? We'll try and figure out more clearly what exposure staff is trying to get to that. So jumping ahead to page 25, and we're going to dig in a little bit more and looking at the equity piece. Within equity, capitalization just refers to small, mid, large cap. And on page 26, what we're showing is the total equity exposure. So this includes your U.S. and all of your non-U.S. equities. And you're pretty close to the benchmark in terms of breaking up small, mid, and large cap. You have a modest overweight to small cap. Philosophically, in the long term, we like that. Small cap in the U.S. and outside the U.S. has outperformed large cap over long-term time periods. There are a number of potential reasons behind that. It could just be getting paid for taking on more risk. It could be that it's less efficient. There aren't as many analysts covering that sector. Could be that they're growing faster. It could just be due to behavioral issues around the way people invest. But some of it also moves in cycles, and we've seen that definitely through time. That as pricing changes, if you look in say the late 1990s, large cap became very expensive. The small cap growth became very expensive relative value, and then that reversed. These move in cycles. So it's something we want to be cognizant of, that if small cap looks particularly expensive, you may not want to have that kind of overweight. So again, we don't know if this is something that you have looked at as a board, but you can be aware of, you have a slight overweight to small cap stocks across your global equity portfolio. In general, you probably want to be somewhere between that slight overweight and neutral. So we're comfortable with where you are now, but just being cognizant of that weight going forward. Page 28 looks at our piece of the equity portfolio, and this gets more sort of like the growth versus value balance. And we're showing a few different characteristics because there's no one universally agreed upon metric. Price book might be the most widely agreed upon when we're trying to differentiate between growth and value. Essentially, you're pretty neutral relative to the broad market. You can see you have a slightly higher price book metric and a slightly higher historical earnings growth rate. These would be modest indicators of a growth bias, but not significantly so. And the other thing I should mention is, again, this is a snapshot in time. This is what they look like on June 30th. That could have changed, a week later, a month later. And this kind of thing that we'll measure with our reporting over time. How does this change? Do you look like you always have a growth or value bias in the portfolio? Any questions so far before I move on? And I should mention, feel free to interrupt me at any point in time as we go. Okay. I'm going to skip. Actually, I'm going to skip ahead to page 30. What this shows is your regional. Yeah, it looks pretty small font when it's up there on the screen. It shows your regional allocation versus, again, the broad benchmark. And I should note, the benchmark we're using there is the ACWI IMI. So ACWI means All Country World Index. So it's including the U.S., all the developed markets outside U.S., and all the emerging markets as well. And then the IMI basically means they're also including the smaller cap stocks in that. So it's as broad an index as you can think of. And you are fairly neutral relative to this benchmark. We show some regional differences, modest underweight in U.S. and slight overweight to, we have Pacific Basin ex-Japan, so that's probably China for the most part, China and Korea. These are things that tend to get more adjusted through asset allocation. So if you were to increase your allocation to emerging markets, that's the kind of thing that will move up the non-U.S. allocation relative to the rest of it. But again, pretty balanced relative to the benchmark. All right. I'm going to skip through the next couple on international equity and jump ahead to page 34, private equity. So we talked earlier about having 9% target allocation to private equity. You're roughly 7.5% actually invested, so you're below target. As Jeff mentioned, is the pace has been a bit slow recently, so which would explain, why you're below that. You recently hired a consultant to help you with that and get you back up to that. Couple of things we would say. Number one, we're fans of private equity because we think it's an inefficient asset class. We think it's one of the highest expected return asset classes. In terms of recommendation, you're already in the process of building a diversified portfolio. One thing we would say, with a plan your size, you have some advantages in terms of, now we've had this discussion around discretion, negotiating better terms, when they could be better fee terms specifically, or getting better access. The other thing is, as you build out staff and maybe you partner with other entities, looking at ways to reduce the cost of investing in private equity. You'll see toward the end of the document, we show the total fees for the plan. We break it out by asset class. And private markets in general are going to be a disproportionately large piece of your fee. I mean, think of the standard fee schedule is a 2 and 20, 2% management fee, 20% carry, with some hurdle in there depending on the structure. And those tend to eat up a lot of the fees of the total system. Anything you can do to bring down those fees without bringing down the expected return can be to the total advantage of the system. And one thing we can do, or you can do, is co-investment. And that's something that I know staff has started talking about internally. It's something that was addressed in discretionary policy, and I think it's something you'll continue to explore and probably hear more about from staff in the next year or two. Page 35, I'm going to spend a few minutes on.
Can I
Sure.
pause and ask something on the private equity? Obviously, we're in an environment that is very challenging for negotiating.
Yes.
Terms, in particular economic terms.
Yes.
As we, let's just imagine this current environment abates, and we go back to a more normal private equity environment and private markets environment, do you feel that LPs such as us have the ability, by making first closes and committing in size, is that
an advantage,
a lever
Yes.
to control costs over time?
Yes, absolutely is. Even in the current environment, I think there are advantages to it, maybe not as big as they might have been a few years ago.
Harder to come by from that
Harder to
perspective.
come by. I mean, there are still some funds out there who know they're going to be oversubscribed, and because of that, say, look, here are our terms, take it or leave it. So
I don't want
there is that reality, but that won't always be the case.
Thank you.
So equity options. This is an interesting concept and one, and I've Jeff was good enough to send us the couple of presentations that they made to the board a couple years ago when they were explaining what they were hoping to do with this. There are a few different ways to take advantage of options within equity strategies. For the most part, the way they've been used traditionally is to continue to get exposure to the equity market, but somehow limit your risk. The most simple way historically was you could just buy, a put option, which is essentially buying insurance. You say, okay, if the market moves below a certain level, we can exercise this put, and we limit our downside. But anytime you buy insurance, you're obviously paying for that, so you're giving up some of the upside because you're buying that. Strategies that's the most simple form, but they can get much more complex. That you can find, okay, if we're going to sell the put, maybe we're also going to sell a call option, which is, say, give up some of the upside, but because we've bought a put, now that we're selling the call, we're actually going to get some income from that, which offsets maybe some of the price of buying the protection. And then you get more complex strategies around that that deal with, is the market very efficient for insurance? And it tends to be the answer is no. Anytime you're buying insurance, people tend to overpay for insurance. I'm not just talking about financial markets, we're talking about insurance in general. And there are investment managers such as AQR, one of your managers in this area, who are aware of that and seek to structure the portfolio to take advantage of that. The strategies are complex. It's hard to necessarily know how they will behave in a period of stress, mostly because options pricing changes through time, and most of these strategies were not necessarily in place 10 years ago during the last financial crisis, during the last period of market stress. I believe when you did your analysis, there was comparison of how does this compare to a credit portfolio, something that gives you equity-like exposure, but with less downside risk. And eventually you decide to adopt these strategies. I don't know how well the commission knows these strategies, understands them, or is familiar with them. We have taken the time to get to know them. We've had a couple of meetings with Russell and AQR to help us understand them. We're actually updating our own white paper on the topic. Because I know you had to go through the same process when you're challenging your own investment beliefs, just to make sure that we completely understand sort of the state of the art, because the state of art is sort of challenging and changing in this particular space. So it's not something we necessarily recommend making any changes. We want to make sure that the commission understands these investments and what their pros and cons are relative to just traditional equity exposure. All right, so switching gears a bit to page 37, start talking about fixed income. In this case, talking about the investment grades. This is a really high quality piece of your allocation. You have a couple of high quality fixed income managers. PIMCO's Total Return Portfolio. You have two portfolios with Loomis Sales, one focused on corporate debt and one on securitized, which is generally mortgage-backed debt. And then you have the Passive Overlay Program, which is essentially giving you broad investment grade. The proxy there is the Barclays Aggregate Index. And also, as I mentioned earlier, the Treasury's position through the overlay program, the Treasury Futures. Each of these has its own specific guidelines, so you're using specialists for Loomis Sales in corporate and mortgage-backed. PIMCO Total Return tends to be a what we call a Core Plus type manager, and you can see that in the pie chart on page 38. Their active manager by Core Plus means they tend to own either securities that aren't in the benchmark or more of the lower quality securities that are in the benchmark. So in many ways, taking on more risk than what's in the benchmark itself. I'm okay with that so long as you understand that that's what's going on. Again, you don't want to pay them active management fees if all they're doing is taking on more risk and it's something you could do on your own, which obviously you could. You could use a passive manager to get exposure to many of these same sectors on your own. One thing we want to talk about when we do the asset allocation is, what's the best use of this part of your portfolio? Most institutional investors see core bonds as their anchor to windward. I mean, right now, the Barclays Ag is yielding somewhere in the ballpark of 2.5%. That's obviously well short of the 7.25% target you need to get. So why do you have it in your portfolio? Well, because this is sort of the insurance piece of your portfolio. When you experience a severe stock market event, such as 2008, high-quality bonds are the piece of the portfolio that tends to hold up, and that's why you hold them in your portfolio. You have treasuries in particular tend to hold up the best, and long treasuries even more so are that true insurance to that type of event. So something we want to talk about when we go through the asset allocation discussion is, do you want to shift some of your core bond portfolio to something like long treasuries? The flip side of that is long treasuries are going to be the most sensitive to any kind of rising interest rate environment. And so there's going to be a trade-off there. You're essentially giving up more exposure to rising rates, but giving you a better hedge to a downside and downturn in equities. And one thing we'll do in December is show you scenarios saying, okay, under these scenarios, if you had more in long treasuries, here's what it looked like. Would you be comfortable with that, or or are you not? The next page, 39, we talk about TIPS. TIPS are also treasuries. TIPS are designed to be a hedge against inflation. They do tend to be more sensitive to interest rates than inflation, but they do have an inflation component to them. You do not have any dedicated exposure to TIPS currently. They are included in the other opportunistics bucket, so they can be allocated to tactically. We believe most institutional investors are well served by having a dedicated allocation to TIPS. Again, you have the treasury component of it does give you, that anchor to windward, and the inflation component generally helps you out over long term in terms of in case there is an inflationary event, they will do well and better than nominal treasuries will. Something we'll talk about in December, trying to figure out what that right allocation is relative to the rest of your bond portfolio. All right, pages 41 and 42, just recognizing you have allocations to high yield bonds and to bank loans. You have dedicated managers in both spaces. We often see managers who can overlap between both, and you do have that. You have some mixed credit strategies and an unconstrained strategy being run by Guggenheim. In essence, we don't have any recommendations. We're comfortable with the way this part of the portfolio is structured. Page 40.
Sorry to interrupt. I just wanted to let you know I'm dropping off the call now.
Okay, thanks, Alan.
All right, thanks. Bye.
Bye-bye.
So pages 43 and 44 deal with emerging market debt. With emerging market debt, you can either have local currency, which is, for example, China issuing debt in their own home currency, or you could have what is known as hard currency, which is generally, someone like Brazil issuing that same debt, but issuing it in U.S. dollars. You have a mix. You have 5 managers and a pretty even split between local currency and hard currency, and some that's a blend of the two. Again, this is a very well diversified portion of your portfolio. We don't have any changes to recommend at this time. Page 45, private debt. So in addition to your public markets debt, your high yield and your bank loans manager, you do have exposure to some debt that is not publicly traded. So this can be direct lending, it can be mezzanine debt, can be distressed debt, can be real estate debt. There are a number of different forms. Coming out of the financial crisis, a lot of lenders pulled out of the marketplace, specifically banks. And so a lot of private lenders stepped into that gap. And that's what you've seen a lot of in this private debt marketplace. You have an allocation to private debt managers. In this case here, you have strategic partnerships. Most of the money is through GSO and Apollo, 2 firms who are very well known for their capabilities in this space. So we have no recommendations there. The one recommendation we have is the same thing we have in private equity and really in private markets in general, which is continue to explore ways to keep the cost down when investing in private markets. Okay, page 47. You have an other opportunistic strategies bucket. We see these sporadically throughout big public plans, throughout our clients. And what's interesting is they mean different things to different people. If you say equities or credit, people know exactly what you're talking about and what they expect to find in that portfolio. If you say opportunistic, well, sometimes it's just meant to be a catch-all for everything that isn't stocks or bonds. Sometimes it's meant to be a tactical component for staff to move in and out of certain asset classes, or it could be they put managers in there who are supposed to be opportunistic in nature. They're the ones moving in and out of asset classes. So it means different things to different people, and that's one thing that we think first you'd want to figure out, what does it mean to you? We've kind of separated out within this. If we take out the commodities, because that's been neutralized, you currently have the Entrust co-investment strategy in there. And that strategy is interesting because Entrust was traditionally a hedge fund of funds. But this strategy is really more like a private equity or hybrid private equity, private debt portfolio, because they're making, capital allocations in the form of equity or debt, generally to public companies. Not always, but public companies who they have tended to invest in as through the hedge fund side, and that's why they're familiar with them and have the ability to make a more timely debt. It has a different wrapper and a different structure than traditional private equity or debt, so it does tend to be a bit more opportunistic. It does also have a shorter time horizon for the most part. One thing I think we can talk about in December, again, is what should be in this bucket. What does the board think of as opportunistic? You've separated out the GTAA managers. Okay, this is now their mandate. They're going to be tactical around that benchmark, which is your public markets benchmark. So that's a different kind of opportunistic. What should be in here? Page 48 is hedge funds. You're getting rid of them. You can move on. Page 49, risk parity. So this is the Bridgewater all-weather portfolio. Risk parity is a pretty interesting concept. Bridgewater make the case that obviously by the name of the fund, that your portfolio should be structured to weather all types of scenarios. The way risk parity is structured is to have equal weighting across 4 different potential scenarios. Growth being faster or lower than what's expected, inflation being faster or lower than what's expected. Whether or not you should have equal weighting to all of those 4 things at a total portfolio level is debatable. Obviously, you and most of your peer groups, peer plans have decided that's not necessarily the case, since there are very few, and in fact, there was one pension plan who at one point went risk parity with their entire portfolio, and that was in San Diego, and they changed their mind 3 years later. But as a subcomponent of your total portfolio, it's nice to have, and one of the reasons, honestly, a lot of particularly public plans have Bridgewater in their roster is to have access to Bridgewater's research. Bridgewater is known as being one of the top tier research producing firms out there. They're great for ideas. Jeff probably does. I read every day the daily missive they send out on what's going on in the markets. So a lot of people have them on their roster for that. One thing we'd like to do is, we'll sit down with staff as we go through fees. One of the first things we do when we go through is look at what are you paying versus what are other plans paying for the same product. It's one of the benefits of having a consultant with a broad client base, because you may think you've got a great fee deal, and we may find out, well, other plans your size have got an even better fee break. So that's something we'll sit down and work on staff with. We're comfortable having Bridgewater on the portfolio. It's just a matter of figuring out what the right size is.
Yeah, I'm all for that, by the way.
Okay.
We'd like a lot of that. They could pay us, that'd be best.
They haven't quite done that. They have agreed to run. They seem to agree to run a treasury portfolio for free. One of our West Coast clients, but they are still getting paid for all weather. GAA or GTAA, as terminology is. So here I'm just going to focus on the GTAA component. So the difference, to answer Mr. Williams' question, from the industry standpoint, the T component there, the tactical component, is implied. Most people would say, okay, that means they're trying to make tactical moves. They're trying to say more in equity or less in equity, more in emerging markets, less in emerging market, more in credit, less in credit at a given point in time. So the tactical component tends to be the most important piece there. Adding global to the front was somebody doing a good job of marketing and saying, well, now it's global, because it used to just be market timing, and they said, well, it's global tactical asset allocation, which makes it sound a lot better. So when we started writing this was before we knew that Jeff was going to propose these 3 new managers, and happily he enlightened us as we were going through this process, and we changed what we wrote. We're very happy with the structure that was proposed this morning for a number of reasons. Number one, giving them a fee structure that I think is more closely in line with what makes sense for you. Number two, it should probably result in lower overall fees. Number three, the benchmark, I think, is going to be appropriate. A lot of these managers have historically benchmarked themselves to, honestly, what is a pretty easy to beat benchmark. Whether it's like a 60-40 or 50-50, if they held any kind of diversified portfolio or they would just hold more risk than their benchmark, you don't necessarily want to pay them for that, right? Here you've given them a hard-to-beat benchmark because it is your total plan benchmark. It is what you're doing in public markets, something that they can replicate. And the other nice thing about that is it makes their baseline the asset allocation that you've agreed to as a board. You said this is the risk and return target that we are comfortable with as a total board, and that way they cannot be dramatically changing that total asset allocation. They'll make small deviations, but given that it's only about 8% of total system assets, it's not going to be enough to significantly change the total risk profile of your portfolio. So we are comfortable with this new structure, and we're very happy to see it, the network, as it were. Okay, page 52, shifting gears to real estate. Currently have 6% in private real estate and 2% in REITs. And that's one active REIT strategy. And then on the private side, over 25 fund investments. That's pretty common for a well-developed real estate portfolio. A lot of those tend to be non-core investments, so it could be value-add or opportunistic. The one thing we'd say is when we do the asset allocation discussion in December, that's a good time to either update or at least discuss, what should that allocation within real estate be? How much of that should be core versus non-core? Because there are different risk-return profiles. Core is going to tend to be, fairly low in this environment, anyways. Fairly low returning. We're talking mid-single digits. Hopefully, not too much volatility. Non-core is where if you're trying to get high single digits or teens, you're going to have more non-core. And that affects the total asset allocation, your expected return. So that's something we can talk about with staff and have as part of the conversation in December. Do you want to have a dramatic shift? Are you comfortable with where you are in that non-core allocation? Infrastructure, page 53, is something that's relatively new to you guys. What my understanding is that you started out with a public markets allocation to a single active manager, Deutsche, with the hope of doing more, or at least doing something in private infrastructure, but haven't been very successful in finding the appropriate investments there, but have been proactively seeking them. In the long term, our bias is that most of your infrastructure investment is better served if it's private market, because most of what we see in public market is very highly correlated with public equity market. So you don't get the same diversification benefits. So we would recommend going more towards private market, and I don't know if that is included in Alborn's mandate or not. Great, excellent. And then on the public market side, even for those plan sponsors who tend to have a big private market component, they often will keep a public market piece, even if it's just as a placeholder or someplace they can fund capital calls to and from. So you would recommend keeping that. The one thing we recommend is considering whether it makes more sense to have a low-cost index fund there. There are 2 or 3 broad infrastructure benchmarks are slightly different from each other in terms of the underlying component. We do tend to have a bias there for passive management versus active management in the infrastructure space.
That's fair. We're not exactly off to the greatest of starts, but
okay.
An active management there.
Page 55. As I alluded to earlier, you have an overlay program that is used more extensively than we typically see for large public plans, but it's not necessarily a bad thing. You're just using it to get, for the most part, index-like exposure, similar to the way that other plans would use their index fund. it's not necessarily good or bad. You know, the fee structure is pretty low. The average fee is about 1.6 basis points based on how much was invested as of June 30th. So obviously that's a low fee. It's a nice fee compared to what you could otherwise be doing in active management. So that keeps your total fees down. You know, so long as you have the proper controls in place, and obviously you've built that out with your system, that is good to have. You know, one option for the very, very long term, since I know today was just a discussion about giving more discretion, giving more discretion to choose managers to staff. The very largest plans are also taking some management in-house. And it tends to be passive management, you know, because even at 1.6 basis points, that's still a couple of $100,000, which might be more than what it would cost you to hire a trader in a Bloomberg terminal. So
Can I ask, that's insourcing a lot of operational risk.
It is.
If your aspiration is just to mimic the index that is cheaply acquired.
Yeah. So that
is there
tends to
more
be
it than just the
that
cost?
tends to be step one.
Okay.
Is
So
that step one tends to be, all right, let's see if we can do this with just passive and replicate the benchmark. And then step two might be, and I think we get in here somewhere, you know, doing something like factor-based investing, something that's rules-based. So again, easy for staff to replicate. That should intend to beat the benchmark over the long term, but that doesn't require, you know, staff making judgments on individual securities.
If that's your destination, I think it makes sense, but
Yeah.
put all this infrastructure in place to save 1.6 basis points or 2 basis points.
It is,
strikes me as just
yeah,
missing the forest for the trees.
they want maybe not. No, you know, and some of the biggest opportunities for fee savings tend to be in private market space, really, and that, you know, the co-investments and again maybe well out into the future direct investing, but that requires different staffing levels as well.
Move to Canada.
It's very popular. Portable Alpha. I hate the name. I'm fine with the strategy. This
you don't
was
like a name that doesn't explain much?
well. This definitely falls in the grade of like one of the great marketing gimmicks of all time. So the whole idea when Portable Alpha came out 15 years ago was that you would get exposure to a market, say the S&P 500, and that would be your beta. And then you would port some alpha on top of that. And that alpha was almost always a hedge fund or hedge fund of funds put on top of that. So the idea was, okay, this is because hedge funds just give you alpha, not beta. Well, we figured out that that's not true, but that's the way it was sold, was we're giving you something on top of the market that's not correlated to the market. Well, unfortunately, you know, they were so effective in their pitch that when that didn't materialize, a lot of the markets kind of turned their back on this. What honestly Portable Alpha in the modern form represents is leverage, because you're getting exposure to the market, and then you're getting exposure to something else on top of that. Something, depending on how it's structured, is going to be in some way correlated to whether it's a stock market, the bond market, the credit market, but something. So you're getting double the exposure, so two for the price of one in some ways. It's not explicit leverage, you know, and depending on what that alpha piece is, or we'll just say the portable piece, what that hedge fund exposure might be, it can make a lot of sense. You know, if the strategy is truly uncorrelated or fairly uncorrelated with the rest of the market, it can give you something that, okay, I'm getting market exposure and I'm hopefully getting some skill that's worth paying for. You know, in your case, you have 4 Portable Alpha strategies. As of June 30th, they were about 7.5% of total system assets. 2 of those 4 with Bridgewater, 1 with D.E. Shaw, and 1 with Lighthouse. So as we mentioned, Bridgewater, very well-respected firm. D.E. Shaw, similarly very well-respected. Hedge fund firm, tends to be very quantitative. And then Lighthouse is a bit of a different structure than the others. The current fee schedule, as you can see, the annual management fee is $29 million, so that's an effective fee of 1.25%. So again, that's going to be a very high piece of your total plan assets, and that excludes any performance-based fee on top of that. Again, with this strategy, we just want to make sure you know what you're getting here. I don't know what staff gave you. I'm sure they were very thorough and explained the strategies to you and what they were trying to accomplish. I'm giving you the benefit of the doubt. It's early in the relationship. But we want to make sure you understand. I mean, and this is our take on it. This is, make sure that, and I'm sure Jeff doesn't strike me as the kind of person who said, oh, yeah, you're getting something for nothing here. These are two things that, in the ideal scenario, it should work. Like if market's going up and hedge funds are doing well, we do better than the market. But there can be scenarios where you perform worse than the market and you get a double whammy if the market's going down. All right. So most of the rest of the document, don't have to spend too much time on it. It's mostly operational issues, most of which because you've had policy statements in place. It's dealing with your custodian. Yeah, you have custodians just need to meet, make sure that that's updated on a regular basis. You have securities lending policy in place. Pages 61 and 62 deal with the expenses, and really the next couple of pages. So 62, this is straight out of your own annual financial report for not this most recent, but the prior fiscal year. And it shows, the average fees by asset class. So you can see the management fee in that third column of numbers up there. And you can see clearly, where those fees tend to be highest are, private market or alternative asset classes. Note how high the hedge fund fee was, and note also, as we said earlier, the hedge funds are going away, which is a good way of bringing your fees down there. You also have performance fees and other fees, which can be significant, especially in a good year. And in some ways, those are the fees you're willing to pay. I mean, if your real estate portfolio is up 20%, you're willing to pay that the additional fee there. What you don't like is paying a fee in a year where, in a hedge fund portfolio where they're getting flat portfolio, or because it's a fund-to-fund structure, the total portfolio might be up, but some of the underlying funds are down, or I'm sorry, total portfolio is down, but it's because some of the underlying portfolios are up, you pay a performance-based fee. What we show on pages 63 and 64 are a comparison to the broad universe in terms of fees, and this is publicly available data. So, we don't know what other large public plans are getting through like a most favored nations clause, but in terms of, what's the off-the-shelf fee for, public equities, for global public equities, well, your fees are, for the passive ones, they're going to be top percentile because, they're passive fees. But even the active managers, you're paying lower fees than average, which obviously is what you want. It shows that you're taking advantage of your scale and your leverage that you have over these managers. And we show it by asset class. Again, there's nothing that really jumps out as overly bad. You tend to be on average paying fees that are either the lowest quartile, or at least in the bottom half of the fee universe. As I mentioned earlier, we'll sit down with staff as we go through each of these to talk about, gee, maybe we're aware of a lower fee that this particular manager might be willing to negotiate.
I think as you look at kind of having an idea of what the fees were for this past fiscal year, and in a year where you had a significant amount of, it was a good year, and I think you'll see a difference in the, I think it'll be a little bit illustrative of some of the efforts that we've taken to reduce costs and fees, once we kind of take a deeper dive into this past fiscal year's fees as well. So I was pleasantly surprised.
The last thing I'll note is page 68. We understand that there's a revised state statute on proxy voting, and as that is clarified, we've expressed that we're willing to work with staff to figure out the best way to make sure you're meeting your obligations there.
questions for Frank?
Just to go back to the priorities 1, 2, and 3.
Yes.
Which things among the ones do you see as more important than the others?
Asset allocation is always at the top of our list. And
Yeah.
just through good fortune, the next meeting is your asset allocation meeting. So that works out well.
And I'm gonna work extensively with Frank and his team, because I want to see an array of options. So, you know, what ultimately comes into that meeting in December is, you know, we'll try to figure that out, but.
Yeah, and it's something I should be clear about. Our approach is not to come in and say, here's the portfolio, choose this. You know, what we prefer is to give you an array of options. Hopefully work with staff to kind of narrow that down somewhat, because what we found, just it's hard for humans to process. We give you 10 different options that they're all going to blend together. Maybe we give you, 3 or 4 alternatives and figure out what those ones are. Maybe some are higher risk, some are not. But to give you those options and then have a dialogue with you, and we're going to have the dialogue first with staff to get their feedback, but have the dialogue with you, make sure we come up with what is appropriate. And we would anticipate, again, talking with you, Dr. Wilder, and the chair beforehand to get your views as well.
Any other questions for Frank or Aaron? I know that's a lot, it is a lot to digest, and so I know what you told us is only a fraction of all the time that you have spent digging into our portfolio. But it is very insightful, and I do look forward to December, where we really dig into the asset allocations and start to address each of the things you have come up with. So I think at this point, we might need a motion to go into executive session to receive legal advice pursuant to the SC Code, Section 4470A2, related to litigation filed by American Timberlands Fund 2 LP, and to discuss investment matters pursuant to SC Code Sections 91680 and 916-320, and to discuss personnel matters related to CEO performance and compensation pursuant to SC Code Section 304070A1.
I move.
Move, and we have a second. All in favor? Aye. Okay. So the ayes have it, and we will move. Now in open session again. We have a motion resulting from executive session, which, shall I read them? Shall I read it or reference the written materials?
I think you can reference the written
Okay.
motion.
There's a written motion in the list. Times Square. Is there a second? All in favor? Aye. The ayes have it. Second motion resulting from executive session is that based on the outcome of the performance review conducted in executive session, the commission authorizes the compensation increase for Mr. Hitchcock as discussed in executive session, and directs the Human Resources Department and other necessary parties to take all action necessary to implement the decision as approved by the commission, and directs that the salary increase be disclosed to the public and in the official minutes after the increase has been communicated to Mr. Hitchcock. Second. All in favor? Yep. We can have discussion. We certainly can.
Without invading the confidence of the executive session, I would like for the public record to reflect that, that Mike's work that I said his work was exemplary, and I haven't had any disagreement with that, so.
Well, thank you.
And I think,
Good job.
yes.
We had a very successful year, and you get a lot of the credit.
Well, thank you.
Indeed.
There's a whole lot of people that are involved in that, so thank you very much.
Yes. All the commissioners echoed the exact same sentiments.
Thank you. Thank you very much.
So now, all in favor? Aye. It's unanimous. Now, if anybody would like to move that we,
Yeah, I know what that means.
and we have a second. Yes, that's right, yes. And all in favor? All right, we are adjourned. Thank you very much.
Thank you.